And boom, just like that, we are live. Happy Monday, everybody. Hope everyone had a great weekend. We will be talking about our weekend, Spencer and I. We were in Vegas for the Fintwit 2022 conference. Was a great time. We'll be running through kind of the big takeaways and the highlights from that. Market today, not too hot. You know, Friday was a great day. It had many investors, I would say, skeptical to say, okay, is this really something we can trust? The Q's up. I don't even know what we finished on Friday, like 3 or 4%. But either way, giving up some of those gains today. Q's are down 1.3%. SPY's only down 0.75%. But overall, red day. We will be talking about some trades as well. We also have Matt Hammond, who will be talking about some IPOs at 12:20, and then Jake Wujastyk, who is also in Vegas at 1:30. We'll run through some charts with Jake. Spencer, happy belated birthday, my man.
Thank you. I appreciate that. How's everyone doing today? Why does our TV not have it has a random skyline? Probably because both of our producers aren't in the office today.
Really?
That's probably why.
I didn't know that.
Yeah.
No, I knew I didn't see either of them. Like, yeah. I didn't know that.
Thank you for the birthday wishes. I had a very relaxing day. When did you get in yesterday? When did you get home? Last night?
Last night, yeah.
Oh, man.
Yeah.
This guy decided to stay an extra day in Vegas. Risky proposition.
Yeah.
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 I hope it paid off for you. MD says you survived Vegas. Yes, but barely so. Barely so. As you can hear, my voice is a little bit hoarse. That's what happens.
All right, wait here. Before we start with the actual content from the conference,
yes.
I wanna ask you this, and we can also
wait. I do want to. Yeah, you do look a little bit tan.
Really?
Yeah, just a little bit.
I don't know when. Like that. I mean, we were at the pool for like an hour one day. Other than that, I was literally.
Yeah. I was at the pool for maybe like an hour the entire time.
I was literally just walking around, which brings me to my next point.
Yeah.
All right, so here's what we're gonna do.
All right, what are we gonna do?
Let me get my calculator out. I want you to guess, and this can go out to the chat as well.
All right.
We'll go down to the 1 decimal, so just the 10th.
Just the 10th. Okay.
Just the 10th.
All right.
How many miles did I walk Friday, Saturday, and Sunday?
All right. I'm gonna cheat and look at my mileage and
okay.
Let's see how we can compare. How many miles?
I'm on my phone right now, and I do have my Apple Watch tracks that. So even like my phone would die, but my Apple Watch is on. So I do think this is pretty accurate.
So here, all right. How many miles did you walk for the whole weekend? Is that what you said?
Friday, Saturday, Sunday.
All right. Well,
I think a lot of the steps Sunday were from like Saturday after midnight, because I don't think I walked around that much Sunday, but I still ended up logging a decent amount of miles. And for anyone that has been to Vegas, you know, it's just a very much a walking, or at least if you're on the strip, like you walking everywhere. And if you're going like somewhere that's like a block away, you gotta like walk up this staircase, walk across a bridge that's across the street, walk over, you know, so like even walking somewhere that's pretty close ends up taking a while.
I don't think I did that much walking, so I'm gonna say you only walked like 3 miles.
What?
No.
Throughout the whole weekend?
Oh no, for the whole weekend. Oh, I'm sorry, I was talking about like a particular day.
Okay.
Because I'm looking at my days here, and so for the whole weekend, yeah, I'm still okay. I'm gonna still say you only did like 2.5, like 2 to 3 miles a day probably. I'm gonna say you did like.
All right, so that'd be about 10.
I'm gonna say you did like maybe like 8 or 9 miles for the weekend.
All right, here, click through here. This is Friday, Saturday, Sunday.
Wait, what? You did not walk. You did not walk 20 miles in one day.
I swear to God.
You did not walk 20 miles. It says 19.8 miles on May 14th.
I swear to God. I just added up. The 3-day total is 47.5.
You did not walk 20 miles on Saturday.
You think this is lying?
On Saturday?
I guess.
Where did you walk after I left you? Where did you end up going, man? Dear Lord.
Yeah. It was a lot of walking around the strip, a lot of walking around at the conference. So the conference was in the Aria, which is a very big.
Wait, can you show me how I can get this data? Because we have the same data, but I don't know how to find what you're looking at.
Well, it might be because you're.
I didn't wear my watch the whole time. Is that?
Oh yeah, right here.
Okay.
So yeah, you walked 8.5 on Friday, 8 on Saturday, and 7 on Sunday.
All
so
right.
that's
Aaron outwalked me by a lot, apparently.
but you still did 23 miles over the weekend, which is
All right.
more than you probably would have guessed.
Yeah. All right.
You said yourself you didn't.
Yeah, I did a lot of walking in the casino to and from the ATM machine, Aaron Sachs. By the way, we have a few people in the chat that I know I met. I don't know if I see them in here yet, but a few of you. It was great to meet some people. Aaron, we had a lot of fun.
We did.
Man, we had so much fun. I can't wait to talk about it. We had such a great time. I was so excited. It exceeded my expectations. They were already high, and it exceeded them. So let's get started. Everyone, drop us a like, and here we go.
This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wujastyk from TrendSpider. We have a breaking news.
All right. How are we doing today? How is everyone's portfolio? Mine's probably down. What else is new? All right, here's what I thought we would do to start the day off because we don't have that much going on today. Today's kind of like a recovery day, the way I see it, right? Today's a recovery
For the
day.
market or for us?
Well, the market had a nice recovery day on Friday, so I don't know if that logic applies.
Okay.
I was thinking mostly for you and me because
Okay.
you got in last night. I got in at 6 a.m. Sunday morning. I slept like half the day yesterday. Still recovering, it seems like. But I thought we would just run through some of our like favorite moments because I know that you and I definitely did not. Nobody got to see the entire thing because we had 2 tracks going simultaneously. So for everyone that was there, they obviously couldn't be in 2 rooms at the same time. So we recorded the whole thing. We streamed it online over the weekend. We're gonna make that, if we haven't already, we're gonna make that stream unlisted and just give it to the people that were there so they can see what they missed. But you were in one room, I was in the other. Did you have any highlights and any favorite moments?
Yeah, so I would say, speaker-wise, honestly, the very first kind of keynote speaker, Brian Shannon, I thought was
good.
great. Room was packed for that one. Outside of the actual speakers, I think the best part was just kind of connecting and being able to make some, do some interviews, make some content with some of the people that are doing really interesting things in Fintwit specifically. So, Gav from Wolf Financial, which by the way,
Oh wait, it's pronounced Gav?
yes.
Oh shoot, I
learned
was saying
that this weekend.
I was saying his name wrong the whole
Yeah,
time.
it's short for Gabriel.
It was Gav.
Yeah, everyone does, and he doesn't
Correct you.
he doesn't correct people.
All right, it's Gav.
God, we'll make a
all
note
right.
of that. Blonde broker. So like, these they're building interesting followings on Twitter, so it's always fun to kind of connect with them in person. Outside of that, Spencer, yeah, just my first time in Vegas, thought it was.
What was your take?
I actually really liked it. I was surprised.
Okay.
So because a lot of times like I don't like super touristy places.
Yep.
But the fact that Vegas that is what it is, and they don't hide it, like it is literally like the most touristy place ever, and they just like that is what they are, and they don't hide it. It's like, hey, this is us. We're trying to get you to spend all your money. It's like I can respect that. You're being open about it. So I actually enjoyed it. Had a really good time. I think it's a place. Obviously, especially if you're staying like down on the strip too. Like it's a big city. I didn't really explore a lot of the city. I explored like a 2-mile part of it.
Not even.
Huh?
Not even. You explored like.
I don't know. We walked.
Maybe you
I
didn't.
did a. I'll bet that most people, if they stay a week into this trip, that I saw went into more casinos than they did. I didn't gamble at all of them. I just really wanted to see. I was like,
You didn't gamble at all the whole time.
No. I said I didn't gamble at all of them.
Oh.
I'm saying like I just wanted to like, there's one that's like the Paris one. Like, let's go see that. Oh, the New York one. Like, let's go see that. Like, I wanted to just go see all of them.
Right.
Did the roller coaster. That was really fun.
Was this all yesterday?
Saturday night.
Oh man.
Yeah.
You had way more fun than I did.
You should have stayed next year.
I should have stayed. Should have stayed. Okay, wait. Jay asked what the best presentation was. I guess it's subjective.
I said Brian Shannon.
Yeah, you said Brian Shannon. There was a pair of presentations that were very similar. Chris Capri and Steve Place both gave presentations about Gamma and how that's ruling the market. I thought those were both extremely, extremely interesting. What else did I like?
And we've talked about that on this show before too.
have.
How kind of the expansion of options trading has kind of changed the overall
Yep.
market.
Yeah,
and how
it's and Steven plays his words. It's the tail wagging the dog. And then there's this really interesting company that I'm going to try to get them on the show here shortly. Alpha Stream. Turns out I had met the founder previously. His name is Gareth Mann. I didn't realize I had met him, but we had met at a prior Benzinga conference. And he started this company that essentially it seems brilliant. I was lucky enough to do a fireside chat with him on stage. The entire idea here is companies like Benzinga produce like a mountain of content all the time, and all that content is going everywhere. It's going into all the major brokerages. It's going into major websites. So if you're using a brokerage, any platform, you just get bombarded with content, right, from places like Benzinga. But Gareth's idea and AlphaStream's idea is like that content should be personalized. Like you should only see the content that's relevant to you. And the onus shouldn't even be on you to determine that. The platform should like read your behavior and determine what you care about and only give you things that are relevant. Just like how we only get relevant ads on Instagram and Amazon gives us relevant like stuff that we bought, right? It's the same idea, right? Why should you receive 30,000 headlines a week when only like 500 of them are actually relevant to you? For example, if you only trade the same 5 stocks, then why should you get alerts or not even alerts, just headlines and content about other stocks that aren't those? So his idea is he's sort of building this platform that operates sort of on top of the brokerage layer, and it like it's like an AI engine, and it personalizes all the content for you. So it'll say, hey, you only trade short-term out of the money call options. We're going to give you a lot of options content. And they're expanding. They're in Europe. They're expanding to the U.S. So they're not really here yet. But it seemed like a very obvious idea that already exists outside of the world of trading, and seems like it could be very useful.
Yeah,
because we get bombarded with all these feeds, man. And it makes sense, right? It makes sense. And the onus, and that's actually the biggest criticism, frankly, of Benzinga Pro, is that it's a great platform, but the onus is a lot of times it's on the end user to figure out how to get the most out of it. We don't always make it as easy for people to figure it out. And the same idea goes for the brokerages, right? The onus should be on them to figure out what's relevant to you, rather than the onus being on you. Say, like, rather than having to make your own watch list and set your own settings, they should say, oh, you look at these charts every day. You have these charts on your screen. Okay, we know what stocks you're interested in. Let's only send you stuff like that. But again, it's like a filter option, but on steroids is the idea. So, anyway, I thought that was really cool. What else jumped out to me? There's a pretty good discussion on day 2 about just the macro environment that I thought was great. Eric Basmajian, I thought had some good takes. EPB Research and Lewis Stevens as well. What else? I'm trying to think. A lot of it was just like the networking aspect, and that's frankly like the big part. That's the main reason we do it, right? As I said, if you're watching on stage, or watching virtually, when I was on stage on day 1, I said we could do those events virtually. We did it virtual all of last year. It is easier, way easier to do a virtual event, but way cheaper, but way less valuable, way less fun. Okay. The most fun part for me was Saturday afternoon, right? After the event was over.
Yeah.
Everybody was just hanging out, talking, having a good time, making relationships. That is where the value is, right? I wasn't in, and neither you, I think we weren't in the inner circle room.
I was a little bit.
Oh, you were? Okay. I really wasn't in there too much.
I was bouncing around.
But it seemed like the people that got the inner circle, that basically had more, like
almost one-on-one access with Chris Capri, Nick Shaheen, Mark Petrino. They were like, this was the best thing we could have ever done. The value was immense. So that's why we do these events in person. We will be doing them again. I don't know when the next trading event will be. I hope we do another one this year. We may not, because I know we have other things on the schedule. But it was a reminder, and I hadn't been. You went to cannabis in Miami. I hadn't been to a Benzinga event in 3 years, and it was a good reminder to me that they are
awesome.
They're freaking awesome. We didn't also mention the celebrity who was at the event.
Oh.
Let me tell a quick story.
Yeah.
About this celebrity. So it's Thursday morning, and I know we'll get to the markets eventually, but come on, guys, we're having some fun here. Thursday morning, so the conference hasn't started yet. I'm sorry, no, Friday morning. It's Friday morning. Conference has not started yet. Conference starts at like 9 a.m. So it's 8 a.m. So people are checking in, getting some breakfast, whatever, yada, yada, yada. And myself, Luke Jacoby, Neil Hamilton are all at the registration table helping people check in. And a man walks up in an orange button-down shirt, an Asian man. And Luke says, "Hey, you look familiar." Which, I don't know about you, Aaron, but I would never say, I as a white person, I would never say to a non-white person, "You look familiar." Like, I could say that to a white person, right? But I wouldn't say it to anyone that's not white. That they look familiar.
I don't know. I disagree.
You disagree?
Yeah.
Okay. But as soon as you said that, I was like, oh, this is going to end up badly. Anyway, it didn't end badly because the person did look familiar, because the person was William Hung. And if you don't know who William Hung is, go on YouTube and search William Hung, American Idol. He was a contestant on this show like 18 years ago. He went viral before going viral was really a thing, frankly. And he, turns out, lo and behold to us, is a trader. He's a trader, and he lives in Vegas. So credit to you, I think. I think you get the credit here because you were the one that decided to do some marketing targeting the locals in Vegas. Was that
Yeah.
That appeared to have reached William Hung.
Let's go.
So yes, exactly. She bangs. So William Hung shows up, and we all got a picture with him, and I got the chance to talk to him on camera for a couple minutes, and super nice guy. No, I did not ask him to sing before anyone asked.
Someone did.
Someone did? It wasn't me. I asked him if he gets asked to sing, and he said yes, and he doesn't usually do it. So I didn't want to be like an asshole. And
I'll be honest, when you came up to me and you were like, "Yo, William Hung is here," I had no clue.
You didn't. A lot of people didn't know who he was. My friends didn't believe it. That's how crazy. Anyway.
So, but so I didn't remember. So when I think of like American Idol famous flops, I think Sanjaya first and foremost.
Okay.
I think that Pants on the Ground guy. That was another good one.
Wait, he was on American Idol?
Pants on the Ground?
Maybe. I mean, I'm confusing him with someone else.
And there's a few other like really good, famous, like just terrible auditions. But for some reason,
but he was the first.
Let me see the year, because maybe it was just I was too young.
It was 2004. We looked it up. It's 2004.
Okay,
So
I was 7,
yeah,
but
yeah.
that's probably around when some of these other, like, I remember we used to watch. That was like kind of the peak of American Idol.
Yeah,
was, like,
yep, exactly.
Season like 4 and 5, you know.
No, there's no karaoke contest.
Wait,
Chris,
before we get to the markets real quick, and,
Yeah.
and we'll keep fielding questions about Fintwit, and there
Yep.
probably is some other things to discuss. But I saw Happy in the chat talking about the Calgary Flames.
Oh, is Happy a Flames fan?
I think so. He said,
Oh,
"Go Flames, go!"
Happy, congrats,
well,
man.
so whether you're so what's going on right now, and we won't spend too much time on sports, but for hockey fans, 3 Canadian teams were in the playoffs this year: the Leafs, who lost, the Oilers, and the Flames. So the Oilers and the Flames will be playing each other. Canada hasn't won a Stanley Cup in like 30 years, and it's kind of become this
No, more than that. I think. Oh no, 90
something. It's
92.
become this like whole thing in the hockey
91.
world, because obviously Canada is so hockey dominant, and
Yep.
they haven't been able to bring home a cup. Happy, I'm excited for this Flames Oilers series.
It's the Battle of Alberta.
Yeah, and the winner will, I hope, play the St. Louis Blues. Calgary actually has a guy on the team, Matthew Tkachuk, who is Keith Kachuk's son, who is a St. Louis Blues legend.
Yeah.
So if the Blues and the Flames end up playing each other, that will be a big media storyline. Just the Kachuk, kind of Keith Kachuk, Matthew Kachuk thing.
I'm going to say that after my favorite team, which is the Devils, my favorite hockey sweater is the Calgary Flames.
Okay.
Those sweaters are just chef's kiss. Beautiful.
And that's definitely, hockey jerseys are like a great way to pick your favorite team. It's the way as far as I'm concerned. Yeah.
If you don't have an allegiance, go buy your favorite hockey sweater and make that your favorite team.
Hunter, we will. One second. I have one last thing.
Hunter's getting pissed. I get it. We're a little bit distracted
I
here.
have one last thing.
Wait, who blocked him?
I didn't block it. He was spamming. He put the same thing in twice in all caps. You get
Hunter, I'm sorry for blocking you.
You get a 5-minute major for that. We're talking hockey. You get a 5-minute major for all caps.
All right.
Same thing.
Sorry.
It's not a block. It's just a penalty.
He's on timeout.
It's just a penalty. Spencer, something happened last night in the sports world that I personally thought
I had a feeling we were going to talk about this.
I would never see in my lifetime.
I know. Do you want to share what it was?
Yeah, you know what it was?
I know what it was. I saw it this morning.
So last night, St. Louis Cardinals.
So you guys know Aaron's from St. Louis, right?
Yeah,
so he's a big St. Louis Cardinals fan.
Yeah, and I was like 5 when Albert Pujols started playing for the Cardinals. So literally for like 12 years of my life, from like 5 to like 16, he was the best player in baseball and my favorite player. And St. Louis just loved him. Pujols ended up pitching last night. Never thought I would see it in my life, but we were beating the Giants like 15-4 or something. And so he comes in and it was on the day that Yadier Molina and Wainwright became the all-time most winning battery. So it's just like all this, like what year is it that you have Yadi going 3 for 4 with a home run and 4 RBIs, Pujols going 2 for 2, Wainwright getting the start and the win. It's just
It's 2008 all over again.
It's amazing, and it was a great way to.
All right. I'm happy. You're happy. I'm happy that Happy's happy. Everyone had a great sports weekend.
All right, but now let's get to the market.
Vegas was awesome. The takeaway from this conversation is next time we do this event, it probably will not be in Vegas, but next time we do it, you should come. Is all I'm going to say. Fintwit 2023 date and location TBD. All right. Let's go to the markets here. We are, the last I checked, we were bouncing a little bit. Let's pull up my pro here and pull up my my handy dandy SPY chart up on the screen. Yeah, so we had bounced a little bit from earlier in the session. Where's my Benzinga Pro? Come on now. You can do it. There we go. Not much to say. Really just kind of quiet out there, Aaron. And you and I weren't here. Oh, no, you did a little show on Thursday. Did you a short little thing, didn't you? Or no? Without me? Whatever. You and I weren't here on Friday, though, so we missed that follow-through from Friday. So now here we stand, Aaron, and the question of the week is last Thursday. Was that the low? In the SPY, I'm talking about 385. In the Qs, I'm talking about, what, 284. Was that the low? Is the low of the move in, or is there more downside? I saw a stat this morning from Ryan Dietrich, who is a friend of the program. Ryan Dietrich noted that the S&P 500 is down for 6 weeks in a row, which is the longest such streak since 2011 for those keeping score at home.
Yikes.
So not great.
Not great, Bob.
But again, the question, let's take a survey in the chat. Is the low in? I'm going to go ahead and say no. No, it is not. I'm going to go ahead and say we're going to get more downside going forward. Why do I say that? Because nothing has really changed. I still am maintaining my thesis that the year is going to be chop. So up, down, up, down, up, down. I think it's entirely plausible even, that we do end up going at some point SPY back to like 420, 430, 440, whatever. But those gains won't hold because they won't. So I think we'll go higher and we'll go lower. We'll go higher. It's going to be a chop fest. I've been saying that all year. And I was right more or less until the past couple of weeks as we continue to make new lows here. But I'm going to say no.
Low is not in here. Your take?
I think I'm not gonna say the low is in. Like I'm not gonna call the bottom. I'm not gonna say last Friday was the bottom. I do think we are very, very close. I think specifically
Ooh.
on the big names, the Apples, the Microsofts, I'd be very, very shocked if, say, we draw down another 10% on Apple. So that would be bringing us from 146 down to like 130.
Yeah.
I'd be surprised to see it drop further than that. So,
yeah, the individual stocks is a different question entirely, right? Because
I think by looking at the biggest names, Apple, and so some of these other stocks, like I wouldn't be surprised to see some stocks that still are very expensive by traditional metrics. So like a Tesla or something like that, I wouldn't be surprised to see those continue to drop maybe more than 10%. But the Apples, the Amazons, the Facebooks, Microsofts, I think looking at those, I think they could drop 12% and then start coming back, so I think if we see that, then that's going to be kind of indicative of the overall market because we know how much these make up for waiting.
Yep. And the reason I said like the individual stocks thing is sort of different because like at a certain point, and a few of these stocks have gotten there already, these growth darlings become value plays. You can argue that it's the case for Facebook right now. You can argue it's the case for Netflix right now, that they're value stocks.
And I want to, on the same note, and I'm not going to go as far to say this is a value stock, but I think it is getting tremendously undervalued. I'm going to pull out my Benzinga Pro. So
who you got for me? You got a surprise?
Yeah, I don't know if we've talked about this stock on the show in a while. Definitely talked about it before, but I did point it out last week. I don't know where, maybe in the trade ideas thing on Benzinga Pro. All right, so here I'll share my screen. We're gonna run through some financials real quick.
Oh, he's gonna bring up a financial.
So we're looking at Rivian Automotive here.
That's not a financial. Oh, you meant the financials of the company.
Of the company.
Oh, okay. Rivian, a value stock.
So this chart. Well, hold on. I said I wouldn't go that far, but I said I think it's getting undervalued.
That's what you said.
So this reached a high after the IPO of around $180. We're down to 25. The chart looks as ugly as you can get. I guess the only kind of nice thing you could say something nice, or don't say it at all, is that this looks like may have stopped going down temporarily. All right, but here's where things get interesting. So go to the overview. We're going to look at the market cap, which is, I believe this is from Friday's close, so it's actually a little bit lower than this because Rivian's down about 5% today.
Okay.
Rivian's market cap is about $22 billion. So essentially, Spencer, can you give the audience just a brief breakdown of what that means? It's value of all the shares outstanding.
That's what the company's worth.
What the company's worth is $24 billion. So if you had to guess, right, and this company was worth $24 billion, they only have about $1 billion on debt, which is not that much. How much cash do you think they would have?
$1 billion is debt is not that much. I mean,
I think their debt ratio, because look, they have, and here's my point, they have $18 billion of cash. So the fact that they have $1 billion of debt, but they're holding $18 billion of cash shows me that they're not like short on cash.
They have 18. That seems like a lot for
a $24 billion company, and that's what I'm getting to is that essentially the market is valuing the actual company of Rivian at like $4 billion with a market cap of 24, and I just think Rivian's company's got to be worth more than that. They already, unlike other of these companies, EV companies that are kind of pre-revenue, like Fisker, Lucid, you name it, Rivian has like signed contracts with Amazon, I believe the federal government as well. So they pretty much have guaranteed revenue. I've also talked about this before, just as far as being in the U.S., being a kind of U.S. automotive player, you gotta be in the pickup game. And that's Rivian's whole thing is they made a conscious effort to say, hey, we are going to try to take some market share of the electric pickup market. And Ford is going to be huge. GM's going to be huge. Tesla, I don't know when we're going to see a Cybertruck.
Okay. All right. So let's cut to the chase here. Are you buying Rivian?
I am.
You are?
Yes.
Oh boy.
I'm starting a position. And
all right.
knowing that, because here's the thing.
Okay.
If it draws, it's $25 right now. If it draws down another 20% to $20, all right, I might add some more shares there too. But who cares? I'm going to hold this for 10 years. It's not going to make a difference to me if I get it at 25 or if I get it at 20.
All right. I have to quote Brian Shannon here, who was the first presentation at Fintwit on Friday morning. What did he have the whole room say?
Don't buy stocks in weakness.
Don't buy stocks in effing downtrends.
Yeah, I think that would apply more for traders if I was looking at this for like a swing trade. But the fact that I'm like targeting a 10-year investment on this is I'm just not really concerned about the chart.
Okay. All right. So Aaron is buying Rivian here, and you're sort of taking the long-term approach, which
They also
respect.
reaffirmed how many vehicles they were going to produce.
I wanted to mention that was on a Wednesday, wasn't it? I think it was
yeah.
on Wednesday. Okay, somebody was asking. Oh, I forget who it was. I'm sorry, I'm so bad with names. Somebody was asking about Rivian's earnings on Wednesday before they reported, and my take on it was, what's the best thing they could possibly say? The best thing that they can possibly say is that we're just gonna reaffirm our prior numbers, which is what they did. That was the best case scenario. So is that sure? That's better than Canoe, right? Can you pull up GoEV on there? It's better than Canoe, which said there's a going concern. Better than Lordstown Motors, which is selling off assets right now. But that's how low the bar is.
Okay, so we had two kind of big headlines for Rivian last week. One bullish, one bearish. The bearish one was, I don't know if you saw this, Spencer, but the headlines were like Ford sells shares of Rivian. Like basically,
yeah. Ford is getting it. They have more. They're not selling all their stake.
Well, yeah. So that's the thing is like if you just read the headline, you would think I think it was a bigger deal than what it was. If you looked into it, Ford held and it's somewhere. I think my numbers are right, but it's somewhere around here if they're not exactly right. I think Ford had like 110 million shares of Rivian, and they sold 8 million shares. So they're still holding 102, and that's like just from a. I think, and maybe they have a plan where they're selling a certain amount of Rivian shares. I don't know how long they plan to hold that investment, but as long as Ford does hold its investment in Rivian, that's showing me that they think, which I don't know. Do we have like other examples of like competitors holding shares of?
I mean
holdings?
GM. I mean we had the whole GM Nikola fiasco, which didn't end up.
Yeah. But basically my point is I think Ford would know better than anyone, and I hear Happy's point that he'd rather have an electric F-150. I think I would too. Probably a lot of the market does feel that way, Happy, but I think Ford, while it's holding its shares, is basically saying that they believe in that company and at least believe in it enough to want to be exposed to Rivian's growth. And I want to be exposed to Rivian's growth as well.
Like in theory, these companies should be experts. Let me rephrase. In theory, the traditional automakers like Ford and GM should be experts at valuing an EV startup. Shouldn't they not?
I agree.
In theory. But then again, GM almost invested in Nikola at the top, no less. Maybe not at the top, but near the top. That was a train wreck. So how do you square that circle?
Basically, there are a lot of like pre-revenue EV companies that have just gotten absolutely smashed down. I like Rivian more than the rest of the group for a couple different reasons. They reaffirmed that they're going to be able to produce all their trucks. They have experienced investors and backers and managers. They have active contracts.
So maybe this is the winner. We don't know, but maybe it is.
Who knows?
Yeah.
I do think out of a lot of other names out there, Rivian is one of those stocks that does have the potential, if you're looking for, which kind of what I'm looking for as like in terms of an investment like this for me is a long-term growth investment, something that really has the potential to 5x 10x over 10 years. So looking at the market, I think I would rather own Rivian here than maybe the Fiskars or I'm bearish like Tesla. already said that they were going to have like a certain amount of the market share of like pickup trucks with the Cyber. I'm very bearish that the Cybertruck. I haven't seen one.
What happened with that? I don't even really know what happened with it.
Like I think the original release, the OG release date for the Cybertruck was like 2020.
Maybe.
I don't know. Shelly's saying now is not the time for speculation. I mean,
No. Now is not the time for short-term speculation.
Right.
Now is the time for long-term speculation.
Investments. Yeah. If you're looking to make any long-term investments, now is a great time to at least start positions. And that doesn't mean, I've said this many times on the show, but say I had $1,000 to invest in Rivian, I don't have to put that 1,000 all in right now. I can put in 300, and then if it dips, put in 300 more, and then whatever, and then but keep my cost basis the same, keep my whatever I was going to initially invest the same.
Yep. All right, so I put on my scanner in Benzinga Pro. I'm looking at movers on the left. Got my signals tool on the right. Just kind of this is how I keep an eye on the market throughout the day here. Just look at what's moving. If you see anything jump out to you, holler at us in the chat. In the meantime, I wanted to talk briefly about Take-Two, because Take-Two reports earnings tonight, I believe. And let's just go with the trend here, okay? Realistically, is there anything Take-Two can say that will make the stock go to like 120 tomorrow? I mean, probably not, right?
If they scooped in and said that they were going to make the new FIFA.
Oh, maybe if they said they're no longer buying, which they're not going to say. Let's be honest, they're not going to say that because they're buying Zynga. That Zynga deal is going to happen. Oh wait, did it already close? No, it did not close yet. It's going to close.
We also should talk Twitter deal because that's looking more and more like it's not.
All right, but Take-Two, if they say they're making FIFA, which they're not going to say either. So there's probably nothing that they can say to make the stock go to 120 tomorrow, right? I mean, best case scenario, again, like Rivian, they reaffirm all their timelines for all their games, and that's that. But this has been, and this is why I almost don't even care what the numbers are. In fact, I don't care what the numbers are, right? I really don't, because what's the expected move here? Let's see if we can find let me go to the different page here and find the expected move in Take-Two. Expected move on Take-Two is 8%. So what's that, like $9? So $9, $8.5, somewhere $8. We'll call it $9. I don't know if that's right exactly, but somewhere around there. I'm biased, bearish biased for every earnings report on any single technology-based stock right now. So we have Take-Two tonight. It's not the only one reporting this week. We have a handful of other big reports. But Take-Two, don't like it. And I don't even care if they beat. I really don't. I'll be honest. To me, it's not relevant. And just as a reminder, I said this last week, but this Zynga Take-Two deal, it's a cash and stock deal. Okay? So if you're thinking about maybe trading this earnings report at all, maybe don't catch Take-Two. Maybe look at Zynga. Zynga will do whatever Take-Two does. Take-Two goes up, Zynga will go up. Take-Two goes down, Zynga will go down. That's why Zynga is down like this, even though it's getting bought, because it's going to trade with Zynga with Take-Two stock. Okay, you mentioned Twitter. Man, am I glad as heck that I sold that thing at 50, because it is now at $38. And
think about
just a train wreck of it.
I wonder if there's someone out there who's gotten, not like intentionally burned by Elon, but maybe, he lost some money on Dogecoin when Elon was tweeting about it. Maybe he bought Twitter for the arbitrage, thinking that Elon's going to get this deal through. Maybe he bought Tesla at the top. It's just like, I just don't like the fact that right when this deal was announced, like the next day where Twitter was trading at, basically it was like, it was trading as if it was a 95% chance that the deal was going through, and I was always saying it's like 50-50. I'm just upset because even though I kind of called it, I don't think I traded it very well. I bought Twitter puts that like I think like in the first week after the deal that was announced, and the stock didn't really move that much. And then what I really should have done was just bought some like cheap kind of Twitter puts that were like 20% lower than the price, but like a couple months out, just waiting for this drop that finally happened. But two things happening. So after the deal was announced, the Twitter deal was announced, Spencer, the tech stocks and really social media stocks in particular like drew down another like 25-30%. So Elon Musk knows if he goes through with this deal at the original price, he's way overpaid.
He knows he made a boo boo.
He's way overpaid.
He made a boo boo. He knows
The
it.
second thing is you saw him tweeting about this thing that Twitter said about 5% of their accounts are bots. He's looking for something.
That's just bullshit.
Right. He's looking for something to find a reason, which by the way was like a lot of people's take from day one was like, this is something that it's gonna be all anyone's talking about, which is exactly what happened. For like 2 days, all anyone could talk about was Elon buying Twitter.
More than that.
Yeah, probably a week. And then he's going to find some excuse down the road for why it can't happen, right? Not that he doesn't want to do it anymore, but it can't happen. It's not his fault, but it just can't happen. So I have seen some kind of independent researchers find that number is actually a lot higher than 5%.
I think we all know it probably is.
I think closer to 18, 20.
Anyway, what did we always say? Best case scenario, Twitter stock goes to 54.20. Worst case, Elon pulls an Elon and this thing goes. I mean, how low can it go? Is the question. How low should it go?
Yeah.
I think 30s is fair. I think where it's at, I think, all right, let's just pretend that like Elon totally pulls out of the deal, whatever. I think what's reasonable? Do you like 30, 32? I think that's fair. We're almost there now. So anyway, hands off for me. You just don't know. I guess if you really want to take a lottery, you could do it, but I really wouldn't. Yeah, it's just a mess. The whole thing is a mess. All right, it's 12:15 on Monday. Usually at that time we bring on Matt Hammond to talk some IPOs. I know we don't have any major ones this week, at least that I saw, but Matt's always got a couple up his sleeve. So let's bring on Matt Hammond from IPOwarriors.com right now. Matt Hammond, how are we doing, sir? Oh, wait a minute. We can't hear Matt. Can you hear Matt?
Well, I can't, but I don't have my headphones on.
I can't hear Matt either. This ain't good.
Hopefully it's not on our end.
All right. If you can hear Matt, put a 1 in the chat. It could be on our end if you hear Matt.
Then we will be...
Because then we have a problem. Then Aaron and I have a problem. Oh, Matt is muted. Okay, great. So it's not our fault.
Not great, but it's...
Well, not great, but...
It's great that it's not our fault.
Hello. Hey, yes, we got you.
All right. Testing. 1, 2. All right. We're live?
We're good.
All right.
We're live, Matt. How are we looking this week?
This week looks pretty slow, but there is, like you said, there's often something kind of hidden and potentially lurking for an upside that we don't otherwise, have on our radar. And we will get to that in a minute. I missed last week because had a hospital visit, and you can spend hours waiting in public hospitals in Portugal for very basic tests, and then find out that all you had to do is go bug the administrator a little harder, and then they'll put you through. But yeah, some simple pregnancy stuff. All seems to be fairly
everything
well.
all good.
But
good.
Yeah.
Everything is all right. Good.
Relatively. So yeah, fingers crossed there. But sorry to miss it. So one thing we can review a little bit is what happened the week before, because there were some interesting things that.
Do you have your charts you can share?
I do. We're going to go back and we're going to go look at Austin Gold, which we probably talked about 5 or 6 times. It kept getting rescheduled. And by the time it went live, I was actually kind of interested in this one. It was my daughter's birthday, so I simply wasn't trading that day, May 4th, also known as Star Wars Day. May the 4th be with you. So what happened here was it priced at $3 and debuted at $6.50. Now, this is on the American Stock Exchange, the ASX. So I do not have a reliable source for viewing the pre-debut indication like price, where I do have that for the New York Stock Exchange. You can see it on nyse.com. On the NASDAQ, you can see it on Weibo Level 2. So I'm looking around to try to find a. I got to share my screen. Sorry.
Yep.
This is much more interesting than what I look like. So let's get that up. There it is. Can you bring that up, Spencer?
There we go.
There we go. So when I see a low float, low price, IPO by a second tier underwriter, the debut is at a sort of odd premium, but not, once they start debuting them at like a $5 IPO opening up at $30 or $40, you can't go chase that. But when you see them priced at $3 and debut at $6.50, that's often a good sign that something's up, especially when the volume is down at, we saw here, the volume was like 34,000 on the opening print. Wait, that might be at the end of the day. But the volume on the opening print was very low. And when you see that setup, it to me tells me that someone has a lot of shares and has basically decided that they're not going to sell them, and that someone else is on the other side of the deal, or the market is just sort of anxious to buy. A certain number of people are going to buy on the debut, and that forces constrained volume. And what we get typically, and we saw this with JCSE, we saw this with GNS, we saw this with OST. We see these just rip up into halt. After the first halt, it kind of wakes up a whole bunch of day traders. They come in and often will push that second halt. Then it's on the halt list. Twitter, a bunch of Twitter accounts that just call out the halts that people follow. And, the market was not particularly strong, or hasn't been for the last couple of weeks. So when there are these kind of opportunities, it seems like people just kind of fly into them. But we've seen these reverse incredibly quickly. I mean, it used to be maybe a year or two ago where we had this kind of setup where it would kind of find a baseline maybe around 10 or 12, and maybe even get a little bit of second halt on day two, a second run. Recently, we've just seen these go round trip, and we saw OST go from 4 to 35, or no, went up over 40 into day two, and then it came all the way back down below 4 on day two. So that was kind of one of the fastest round trips I'd seen until this one. And this one debuted at 3. It topped out at 29. Even if you didn't get IPO shares, this was available for allocation request on Webull. But even if you didn't get in on that, even if you just bought in on the open at 650, I mean, you're looking at over 300% potential gain. I wouldn't hold past 3 halts. I kind of have what I call the 3 halt rule for these, which sounds a little bit ridiculous, but these do happen rather frequently. So this is one of the setups that I love to see in IPOs. I won't necessarily hold on everything into that third halt. Something like this, I'd probably sell at least half my position either out of the first halt or out of the second halt. Like to leave a little bit into a third possible halt, but that's where I'd be getting out 1, 2, 3, maybe 40, 40, 20. And the potential upside for this kind of play is awesome. Don't get greedy. One of the reasons I don't, often we'll see these baseline and then end of day run, but this can just as easily happen once it's decided that whoever's been holding it has seen enough and are ready to take their profits. Remember, whoever is holding this probably bought in at $3. So it's all gravy for them, even if it's just, bleeding rain out of the sky at that point. But that was definitely an interesting IPO. And these are the kind of setups that then will lead to potential runs in other low float setups, even when they aren't constrained floats. The next one I want to look at was because we have 2 mainstream IPOs to cover, one from the week before and one from last week. And I want to kind of point out a trend that I've talked about many times on this show, is that when the market is really weak, we're not going to see a lot of IPOs come to market. IPOs are growth companies almost by definition. And when an IPO happens in a hot market, people are hungry for the next, new, innovative, exciting company to come live. And in 2020 and 2021, when we saw record IPOs, we saw a lot of IPOs debut at huge premiums to what the IPOs had been priced at, and we saw IPOs getting priced way out of range. I mean, a great example that I keep referring to is Bumble, the dating app, and I think the price range was like 32 to 34. I think they priced at 36 out of range, and they debuted at like 76 or something crazy like that. They went up a little bit, but it then came right back down. It took about a week or two. It spiked up on their first earnings report as a public company, but now it's what I don't even want to look. Or I do, because I have another point to make here.
Okay.
BMBL is at, no, that's not it. BMBL. Yeah. I'm not too thrilled with it's now, it's at 25.95, so below IPO price and way below if you tried to hold buying the IPO. So what I like to point out in weak markets is that when IPOs do go live in a weak market, we typically see much friendlier pricing for retail traders, and especially when it's JP Morgan, Morgan Stanley, they tend to leave a little bit of meat on the bone for retail traders, whereas Goldman Sachs seems to just kind of vulture as much as they can for themselves, and I'm really careful with anything they bring to market that's not piping hot in a strong market, because they'll just they'll run the debut price up to a point where there's almost no further upside left. This one, I believe, was JP Morgan. It was one of those two. I forget exactly which one. But the market was not doing well. Had a little bit of a rally on this day, I believe, and they priced it at 18, and the range had been 21 to 24. So already they're kind of like saying, well, while we're pitching it to institutional investors, we believe we can make a case for $21 to $24 per share. Institutional investors said, nah, I mean, in this market, you're going to have to give us something safer. How about 18? They took 18. And actually, at this IPO, they weren't raising money for the company. It was a spinoff from Bausch holding companies, and all the money goes back to the parent company. So this company didn't go live, didn't go public because they needed the money. But it did go live at a price where you're already below the ask price, or the low end of the range. The debut premium was very minimal. So to me, on an IPO trade, I see it as an opportunity to take a relatively safe entry on the debut. I'm not expecting it to just go wild on this. We've already seen that demand isn't that high, or they would have priced it within range. But there was an opening run. You could have pretty easily taken almost $1 just off of the run, the kind of run and spike, or just hold it for the day. Put your target at like 20, sell it at 1985. I always, I'll kind of make my mental targets at the big numbers, the big round, lots of zeros in them numbers, and then undercut that by 5 or 15 cents just to make sure that I get filled. I think this one right here hit like 1997 or something. So if you went to 1985, you were safe there. If you missed that and it fell off, you'd have been kind of bummed if you just went 20, because a lot of people are putting in 20. Ended up getting a little bit of an extra high there, but this was a relatively safe setup, and I like this. I like this setup for a play, and I like that in a cold market. Any mainstream IPO that goes live, especially if it prices below range, especially if it debuts below pricing, which is something I would not touch in a strong market, or priced above range, or on a low float, one of these kind of second tier offerings. But on a mainstream IPO, that is a good setup to look for. I'm going to cover this one because I never see bank corps run like this. But I did point out in my newsletter, sign up for the newsletter. MailChimp sends it out. It's thesound.com. You'll get these ideas. Some of the ones last week. The ideas and kind of call outs that I made actually help people save money by what not to play. So I kind of try to, give my forecast both ways. But in this one, the float was 1.3 million shares, and recent low float IPOs had just gone crazy. So I said, well, the next one that comes out could do something interesting. It didn't really do anything interesting on day one. Most bank corps are kind of priced to perfection. They don't do a whole lot. Priced at 120, debuted at 21.44. Little dips within $1. That's actually a little bit uncharacteristic to see that far of a swing. I often don't see ranges more than like 20 cents down or 20 cents up. Kind of regained form right here in the middle. But then in day two, I guess that low float did kick in. Some trading group probably accumulated here, maybe even at the end of the day on this wick down, and then pumped it into a run up almost to 25. I mean, if you saw this coming and said, okay, well, I'm going to take this at 22 or 23 or 24, you could have made profits. It's not a bad trade because the downside is rather limited, but I don't typically see these, so I think it was just the low float got keyed in on. The last one is ProFrac Holding. This is another mainstream IPO, 16 million shares. I believe Morgan Stanley was the underwriter here. Mainstream IPO in a wrecked market tends to price below range, and then this one debuted below IPO price. So I was looking at stepping into this one on the debut when the debut indicator was at 17.15. And I said, okay, well, I'll try to undercut it by like 5 cents and see if I get in. It came back up to 17.60. And Webull, which has its positives, but I got a
Oh yeah, I saw you tweeted this. Wait, explain that. I saw you tweeted this earlier.
So I trade these on margin because I know that I can, as long as I don't make kind of mistakes where I've only done it once and I got hammered for it. But if it debuts way high premium, don't play it especially with margin. But most of these, I know that my downside is somewhat controlled, and I've made so much on playing, with my margin on these because I'm in and out of them within 1 or 2 days, 3 days maximum. So if I take a loss, it's not gonna, it's not a crippling loss. It's all kind of money I can afford to, to gamble with anyway. But I'm okay. I'm totally comfortable with playing with the margins and selling, selling for a loss and then just bringing it all into the next play anyway. But I have some long positions that I've been holding this account. And on Friday, I went to go, place a trade on this one. I went to go place another trade on ASNS, which we'll get to in a minute here. But we both said, please confirm that you're using your day trade buying power, and you don't have any overnight buying power. I was like, what? How did that happen? And then I couldn't figure it out. I couldn't place any trades. I was just like, that's weird because it shows that I have buying power. Like, it shows that I have overnight buying power. So why isn't it letting me buy anything? And then after 8 p.m. Eastern, I got a notification saying, you have a margin call for like $20,000 in your account. I was just like, what?
Jeez. All right.
How'd that happen? Like, I know I got those day trades. Did I somehow did I buy it only under day trading, and I got like a penalty? They totally cut off my margin now, but this isn't my my main trading account, but it's like, I don't want to throw away $20,000. I set the,
how'd you get out of this one?
I didn't get, I was like, literally just sort of like,
So you paid the margin call?
No, I was thinking I kind of spent. So I looked back in my account. It still said I had like a few $100s worth of overnight buying power. I was like, so I can't have. How does this make sense? Why are they giving me? Why do they say I have overnight buying power if that's all on margin? And then now, how are they going to get canceling up my whole margin? Like, they're switching me back to a cash account. What are they doing? Okay, whatever. I guess on Monday I just sell everything and take all my money out and go somewhere else. Then I got a message not even Monday morning. I just logged into my account and I saw that I didn't have any margin notification like I did all weekend. I checked my I said I had a couple $100s of buying power again. I went in and bought 10 shares of ASNS because I think it's at some point ASNS is an IPO that absolutely flopped on Friday and hasn't run yet. It's a pretty low float, so we'll see if it gets a run or not. But to see if my account worked, I was able to buy another 50 shares of that. So I was like, I can't be in a margin call and be buying stuff.
Wait, so
they gave you a margin call, then they rescinded the margin call.
Not just a little margin call, like a huge margin call.
Yeah. $20,000 is not nothing.
It's almost like, yeah, basically like they said, like, pay back your whole margin.
What?
And like, and then they sent me at like 10:15 Eastern today. I got a notification on my phone. So aftermarket already open after I decided not to just liquidate everything and kind of like see if I set their customer service a thing over the weekend. I'm sure I wasn't the only one. But they don't have phone in customer service. They just have, send an email and, it's taking weeks before to get responses. So I thought,
what was the explanation here?
Please be advised that over the weekend, our clearing partner erroneously increased margin requirements on one of your holdings. As a result of increased requirement, a subsequent margin call was issued. Over the weekend, we were able to rectify the situation by obtaining the correct requirements and updating your account accordingly. We apologize for any confusion and inconvenience this may have caused you. Please do not hesitate to contact us if you have any questions or concerns. So yeah, thanks for if this was
ruining my weekend,
potentially ruin your weekend. Seriously, it's like, oops, sorry. And like, what if I had like gone out and taken out an emergency loan and funded my account? Oh my god! I mean, it's not the kind of thing you're really allowed to just go. There should be real penalties for this. Of course, there won't be.
So wait. So to read between the lines there, what they're saying is Apex Clearing, which is the firm that I know we will use this for their clearing. Apex Clearing screwed up, and as a result, we gave you a margin call, and then they fixed it, and then we fixed the mistake for them. So they're blaming that on Apex Clearing. Very interesting. Did they say what stock it was?
No, but it's either Palantir or QYLD. I just take some of my winnings. When I get a big win on an IPO, I'll take a little bit and add to a QYLD position that I've been building for. It's all for my daughter's education. So yeah, it was. It was kind of like, I didn't spend too much, but it did get it's going to work against them because I started already looking at like Trade Zero for their data, Interactive Brokers, just to have some, because apparently even if you're a US citizen, you can go through other platforms to get what's essentially an IB account. And then I can get out of pattern day trader rules with, not having to fund another account with 25 grand. So, I'd love to have like a bunch of $5,000 funded accounts that I could day trade with.
Wow.
So
that is that's never happened to me. I've never gotten a margin call. Neither have you apparently, because that was what it was.
I've gotten margin calls, but I was always prepared to
satisfy them.
Yeah, exactly. So no, I think
you got a margin call.
QILD pays, even though it's down now, it's only down about 10% from where I've always been, loading. It pays 10%, 10 to 12% annually, and your margin, lending is 5 or 6%, depending on 8% max. So there's a arbitrage there as long as you don't get wiped out by QILD. And then they had that huge dividend.
You said QY. I'm sorry, QY.
QYLD.
Yeah,
it's a covered call index. It covers the NASDAQ.
I've been asked about this a lot.
Yeah. And experts will go, oh, you can do that yourself. You can run your own covered calls like that. If you have time for that, good for you. I don't.
Right.
Getting 1% per month is really cool. And I just use winnings to, put stuff in there. And if I do get, crunched into a margin call, I'm not significantly down. It doesn't move that much. So, and then I buy back in, on my next win while it's down. And to me, it's just like, okay, well, if I had known about this for my whole life and just put savings in it up and down, hasn't been around my whole life, but, and maybe it'd be down. The first year it was up at 23, 25. Now it's down to like 18, 50, 19. But it often comes back to when the market rallies, it comes back up to 20 pretty quickly. So I'm sure that there's downsides to it. To me, it's been, cool to have cash coming in every month. Now that I'm living in Portugal, it looks like I can use it to satisfy the D7 visa requirement, which says that you have to have like $800. You have to be able to show that you have like $800 a month in residual income. to apply for this
Okay.
D7 visa, which if you keep it for 5 years, gives you citizenship. So it's sort of like interesting that you can fulfill that requirement. So to me, there's advantages anyway.
Okay. So wait, a couple points, and just
Mhm.
my own point on QYLD is it's convenient. It's a much easier way to do a covered call. The negative is you're paying a premium for it. That's the difference. Is you're paying a premium for the
Yes.
convenience. Very very slight, very small premium, but a premium nonetheless. So if you don't want to deal with the headache of doing the whole thing yourself, QYLD can
Mhm.
work for you. If you're willing to do it yourself, then fine, do it yourself. But to each their own. And then a question from the chat, Matt.
Yeah.
Yeah.
I was
Well, I
going
was
to
going
say,
to ask
as
you.
I understand covered
Go ahead.
calls is, I mean, you're owning the stock and, selling covered calls.
Yeah.
When the stock then drops out, you keep the covered call, but you also lose the value of the stock. So if you had been writing covered
Yes.
calls, just writing covered calls against, you might be in a worse position than owning, QYLD.
Right.
Anyway, and they had a huge dividend. The dividend in December was something like 2.5%. That
Right.
a 50-cent dividend. It was a very nice little end of the year bonus. So
I should add that the QYLD is literally a covered call on the Nasdaq, right? It's
Yes.
not. Yeah, it's literally just it's a covered call on the QQQs and not anything you want. Wait, but this is a question that I had as well, so I'm glad Happy asked in the chat. When you get a margin call, how long do you have, Matt, to satisfy that call?
It depends on the brokerage, and it probably also may depend on how much money you have in it. With E-Trade, where I've gotten a bunch of them just because I like using the margin there. They give me 5 days usually.
But
more than
I would have thought.
Yeah, but they will if like things get even worse. I've had one time where they force liquidated a couple blocks, but it's like then what they liquidated was what I was going to liquidate anyway. So
okay.
It's not great though, because they'll do it at the bottom, and you have to kind of live with that, and it stings. But we're not going through a great time in the market to you want to kind of give yourself some extra cushion. But like I said, with these IPO plays, I mean, OST, JCSC, these were plays that were pretty clear to me that they were going to run the way that they did. So, leveraging my margin on those calls was, was a great opportunity. One thing because we only have one IPO here to cover, and I wanted to point out something, was that, so right now we've seen the market really come down pretty hard, and that IPO calendar will really reflect the market's health. Like I said, we've had kind of like 3 or 4 mainstream IPOs this whole year. The rest have all been, kind of these low float second tier underwriter variety. But one of the things to notice in this market is that the high flying IPOs of the last year are often the ones to fall the hardest when these market crashes occur. And they are also the ones to recover often most quickly when things do bounce back. So if you are in a position where you've kind of kept some cash on the sideline and you're looking for things to to get into if we start to see signs of recovery, I'm not going to pretend that I can call the bottom or advise anyone on when that time is. But there's some very strong companies like Unity Software, Sentinel One. I don't know if I've put Bumble in the list, but they are way down. Airbnb. These are all way down below IPO pricing now. And if you're looking for what where the opportunities are, and a lot of these just on on Friday, when Thursday and Friday we had these rebounds. These stocks recovered very strongly. And this is one of the reasons why I like studying IPOs. One of the reasons I keep my research focused on them is not necessarily to be in them, but to recognize that these are where the opportunities were, both to potentially buy puts if you saw the market turning around, or once you feel like we've seen a bottom, this is where my focus would be for stocks that have a lot of room to recover. They were insane. They had insane growth valuations when that was the rage, but now they're kind of gotten down towards fair, more fair market valuations. And if you're all things being equal, comparing two stocks where one, where they both have similar, say, PE ratios or any, financial technicals that you want to apply, would you rather have the one that's growing at 30 or 40% per year, or the one that's kind of already matured and isn't really, in a position to, Unity is in everything. They're in virtual reality. They're in metaverse. They're, the one of two main platforms for video games. They're used by the Army. They're used for engineering at all, a lot of levels. Sentinel-1 is cybersecurity. They're taking market share from CrowdStrike, Airbnb. You all know what that is. These are kind of. The IPO world is where I keep my eye on.
I can get behind all that. Unity is definitely a name, and it's an idea that is on my list, but I can't get behind buying it right now simply because there's nothing to indicate that the market will change its mind on Unity anytime soon. Okay, it's not the kind of company, not the kind of stock that is looked highly upon right now. I'm just going through some of their key stats here and looking at the revenue growth is really slowed. The profit is actually declined quarter over quarter. Net income is going in the wrong direction, right? Those are the kind of things you want to see right now. So it's
I'm not buying any of these right now. They're just the ones. These are some examples I pulled up a few minutes right before the show. But these are the types of plays where,
for sure,
researching last year's IPOs. I don't know if AI is another example, but it's like kind of on this list.
Man. that was a crazy one. That was a crazy one too, because that thing, I forget what the IPO price was, but it went the IPO here. It opened at 100. And then it went to 170 almost. Yeah, 172. 180.
It opened at 100 and dropped.
Right.
And then it came back on day 2 and ran up to 180. And that was just sort of like, what? I had bought on the debut, held it through the low. And then the next day sold it a little bit more. I made a little bit of profit. I was like, phew, that was scary. Then I went to 130 that afternoon. I was just like, damn. And then it kicked me in the groin and went all the way to 183. But if you bought up there and didn't see it coming, it's been down as low as $13 last week.
Yep.
But you can see that one bounced from 13 back up to 17. Sentinel bounced back to so they get oversold hardest, and then some of these ran 20, something like 20%. Sentinel bounced from 22 to or from a low of 1864 back up to 27. So that's kind of, I'm talking more about yes, there's a long-term vision here, but even when the market really goes into panic mode, these will fall first. You don't want to be, I think you're right. Buying these now is kind of dangerous, but on those days where they start to rebound and you can feel it in the morning, the energy's there. Look for these to rebound throughout those days.
All right, Matt. Before I let you go, there's a question.
We have one IPO to talk about, but yeah, sure.
Okay, all right. Go run through the IPO.
Okay, the IPO this week is called Okyo Pharma. This was rescheduled from last week. It's a British biotech that does inflammatory eye diseases. The only thing that's particularly interesting in this one is that it has gone from a 1.9 million share float to last week it was like a 900,000 share float to this week it's down to 508,000 shares, which has to be the smallest float that I can recall an IPO coming live with. It's also weird because it was originally formed as Emerging Metals Limited. And they have some other kind of weird things in their F1 that says our website address, blah, blah, blah. The references in our websites are inactive textual references only, and the information contained or that can be accessed through our website is not part of this registration statement.
What
It's one of
does
those things.
what does it
Just
mean?
it's so sketchy, and the float is so low, and the underwriter is Think Equity, and it's kind of like, okay, what's really going on here? Obviously, you're really just trying to get something to market. You don't even care if you've cut your. You're kind of like, oh, you're not going to give us 25 million. Okay, we'll take like what 15? Is that? Oh no, you can't give us that. Okay, we'll take like 9 million. Sure. It's sort of like, what is up with this business? You know, and with just 500,000 shares, the opportunity for somebody to kind of not sell and pump the debut is really high. So I'm interested in watching this one and seeing, okay, well, if they've priced this at, looks like they've priced it at like $4.92. If they debut this at like $7 or $8 or $9, that's really interesting for an an AUST type run where it just gets, halted, insta halt, until the insiders go, okay, well, should we sell now? Okay, let's sell now. So for 1 or 2 halts up, certainly could be that kind of play. I mean, with the float that low, volatility is almost inevitable. If it does debut at like 25 or like 30, it could actually, I mean, we saw AERC, that one that went the day before Thanksgiving, that one priced at 10, debuted at 40, and then went up over 100. But I've learned the hard way that at a certain level, it's not worth trying to, to buy a debut premium that's that crazy. So,
Matt, before I let you go, Hunter wants to know whatever happened to BRTM.
BRTM.
Yeah.
Look that one up. I'm not seeing a ticker for that one.
Right. It didn't IPO. That's what he was asking.
What was the company? So when they don't IPO, it's almost 90% of the time it's because there simply wasn't demand, that they couldn't get enough buyers to to support the IPO. And if you understand how IPOs work, there's really kind of 2 levels of IPOs. Like you got the mainstream IPOs, which are led by Goldman Sachs and JP Morgan and Morgan Stanley. And these have institutional investors that they bring every deal to, and they hold themselves to a certain level of quality where they're not going to bring, a BRTM or an AUST or a OKYO. They're not going to bring these to JP Morgan or Goldman, because Goldman's going to go, we're not taking this to our investors. They'll never, if we sell them this crap, they're never going to work with us ever again.
Right.
So the underwriter has a reputation to kind of maintain with the quality of the deals that they're bringing, to their institutional investment level financial institutions. So and that's why in this market, we're not seeing mainstream IPOs go live, because the institutional investors are like, you know what, we don't feel like putting our money to work right now. We're kind of holding our money tight right now. And, we don't want to hear your growth stories, or your, retail's not buying this stuff right now. So we're not going to go buy the IPO, at any price right now. We're just not interested. If you're going to force it to go live, don't expect to get what you're asking for. We've seen 2 mainstream IPOs in the last 2 weeks indicate range at 21 to 24, both priced at 18. So with the lesser known, kind of the tier 2 ones, these ones are going to, Think Equity, Maxim, Bosted, EF Hutton, Aegis Capital. I mean, there's just kind of like this whole sphere of underwriters that are kind of like, look, we know it's crap, but we also know that these things sometimes run. They're low float. So if there's any kind of good spin on them, it's a lithium miner. Lithium's in demand. People will buy lithium thinking it's like a cool thing, and it'll run on day one, and all our, but they're not selling to institutional investors. They're selling to rich guys and girls, traders who flip IPOs, and they're looking for quick pops that they can sell on any kind of debut premium, on any kind of run. Ali Angel talks a lot about, who's been on this show. She's added to the newsletter as well now, guys. The newsletter now has an LPX, the lockup expiration play, because these low float IPOs, they go live. Seems like half of them go live with warrants, and those warrants get can't. The lockup expiration on these is usually like 90 days or 180 days. So it seems like they go live with a piece of news up their sleeve that they then drop as a headline, going into these lockup expirations, so they can pump the stock price up again and then sell into that momentum. So that these IPO setups that are trying to sell to retail, sometimes they're so bad that even the retail buyers aren't going to buy them, even when they're told, hey, you got to buy in on this one if you want to get in on the next big one that's coming up next week. So that's 90%. That's the 90% of the reason why an IPO won't end up going live after announcing is simply there's no market demand. The other 10% is like SEC just shakes their head and goes, no, we don't like what we see here. Rewrite it and get back. Spencer, I want to make one more shout out if you don't mind. Give me like 15 to 20 seconds here.
Why not? Go for it, man.
Okay, so we are supporting. I think some of you know that I got my dogs out of Ukraine about 2 weeks after the war started. A friend of mine brought them across the borders. But as I was kind of going through that whole process, I left 2 days before before Russia invaded Ukraine. So I got kind of lucky. But my dogs were looked after by a nice lady in Lviv. I had brought them from Kiev to Lviv. And I felt really lucky to get them out. And I was kind of introduced to a lot of organizations that are working with dogs in Ukraine to help, bring dog food. A lot of people had to abandon their dogs and, just put them out on the street. So one of the organizations that we've been supporting is Paws of War. And how we support dogs, I'm not asking you to donate any money. Don't worry. You keep your money in your pocket. But we have a program called The Sound. And if you go to thesound.com, we've produced a lot of music. It's mostly background music, piano music. You can even leave it on mute, just above mute on Spotify. And the royalties that are generated go towards dog rescue efforts. So if you go to thesound.com, click on our Spotify and just leave it playing, leave it streaming. It's relaxing music. It's easy to trade to or do whatever, or just put it just above mute. You can't even really hear it. And if you do that, per day, you can generate, about $1 or something like that. Just leaving it streaming. And if you like our stuff,
this is great. I'm going to do this. I'm going to do this because I listen to background music when I work. So I'm going to do this. Thesound.com.
Yeah.
I did not know about this. Thank you. I'm going to do this starting today.
So if you have to go into Spotify, you're only going to get the samples. Spotify.
I feel on Spotify.
But we have YouTube. We have YouTube videos coming up. I think we actually have a couple out now. So I'm going to add the links on the site.
I search for The Sound?
Yeah, I will. I'll get it up in the next 10 minutes, and then
awesome. Because
actually, I think if you scroll down a little bit, scroll down on the website.
Yep.
Scroll down a little more. Okay, this you can put it in your. I haven't added it here. I'm going to add a thing. Oh, there it goes. Spotify has all the albums. And then
Look at that.
On Apple Music, we actually, I think, get more royalties from Apple Music if you play there. But then
awesome.
I'll get the YouTube link up there now, too, because I think we have a video
awesome
there as well.
Thank you for this.
Thanks, guys.
Learn some music. All right. Have a good one, Matt. We'll talk to you again next week. Sorry about that, everyone. All right, 12:54. We're gonna have Jake Wujastyk from TrendSpider join us in a couple minutes. Aaron, while Matt was on, I saw a Rivian headline.
Oh, you did?
Did you see it?
Was it that Ford is selling more shares?
No.
Okay.
Rivian is suing. Apparently, the company that makes the seats in these Rivian trucks,
good for them,
is raising their prices.
Good for them.
So, and that company is also public. It's a commercial vehicle group. So I'll pull the chart up. CVIG is the ticker there. Rivian is suing commercial vehicle group because they're raising their prices. And they say that price increase will affect the production of Rivian's Amazon delivery van. That's what Rivian is saying here today.
Okay.
So
Rivian trying to save costs. I like
here's CVGI. Admittedly, not a stock I've ever heard of before. Down 6 cents today. Not really widely traded. Here's Rivian, which is down 8.5% today, which is only $2.26. But all right. You know what else I forgot to mention? My birthday, Aaron, is always a reminder to me of a certain market event.
Okay.
My birthday, because it falls on May 15th, is always on or around, depending on the day of the week, 45 days from the end of Q1. You know what that means? 13F deadlines are today, which means after the bell, we will almost certainly get 13F filings. We will get filings from all the largest hedge fund investors, hedge fund managers out there. Warren Buffett, Bill Ackman, Dan Loeb, Nelson Peltz, David Tepper, David Einhorn, et cetera, et cetera, et cetera. These are the whales.
Michael Burry.
These are the whales out there required to disclose their trades for the prior quarter. So I always like knowing what they're doing, even if it's not super actionable, because you can buy a stock. If I'm Bill Ackman, for example, I can buy a stock on January 3rd and not disclose it until May 15th. But it's good to know what these people are doing, I think, because this is the theoretical smart money. So as a reminder, that's tonight. We will talk about it tomorrow. But if you're into 13Fs like I am, then today is a big day for you. All right, what else did we miss? So here's the deal. We're going to have Jake Wujastyk on at 1, and then we're going to have a new guest on. New guest alert on the show today. Randy Frederick, who is the managing director of trading and derivatives at Charles Schwab, is going to join us at 1:30. Give us his take on things. So save your macro takes for Randy. What's going on, man? Anything new out there?
I want to talk about Abbott for a second.
Abbott Labs?
Yes.
Okay. ABT? What do we got?
So I don't know, Spencer, how much you've been following, but this has been a big headline, a very serious, important headline for new parents out there.
Yeah. This is messed up,
man.
man.
Been an ongoing baby formula shortage in the United States. So people that are new parents, there's a number of different reasons why parents may want to, or their kid needs to use formula instead of breastfeeding, whatever. So I've seen a lot of people on Twitter be like, oh, it's not a big deal. Like, just breastfeed instead of the formula. Like, that's not how it works. And people are like, well, what happened before we had formula? Well, a lot of babies died. And also for, say, a mom who's, been using formula, a lot of times they won't be able to breastfeed. Anyway, why we're talking about Abbott here is because Abbott is, I believe, the leading producer of baby formula in the United States, and almost kind of has a, I want to say it was 40%, I think, when I read it, that what comes from Abbott. So let me read this part from an article which comes from foodsafetynews.com. There was actually a whistleblower from Abbott, I believe, given some of this information. But here, let me just read this part. For several years, some of the equipment associated with the drying process at the Sturgis site was failing and in need of repair. As a result, the number of product flow pipes were pitting and leaving pinholes. This allowed bacteria to enter the system and at times led to bacteria not being adequately cleaned out in clean on-place washes. This in turn caused product flowing through the pipes to pick up the bacteria that was trapped in the defective pipe. There was a 2019 FDA audit. It was generally known that the Sturgis site was worried about the FDA would find about the micro batches. Throughout the audit, QA leadership kept QS staff apprised, which is quality assurance. One member of management stated the FDA was on the right trail, so she even volunteered that she was amazed the FDA was unable to discover what occurred with the micro batches. So essentially, they're hiding this stuff from the FDA in 2019. Meanwhile, starting in 2019, kind of the March, the COVID stock market crash, Abbott began buying back its own stock, and over the last 3 years has bought back more than $5 billion, actually 5.73, so closer to $6 billion
and this
of its own stock.
This is where buybacks get a bad name, get a bad rep.
I'm gonna venture to guess that fixing the pipes so that bacteria didn't get into baby formula would not have cost $6 billion, but that's what Abbott saw was more important and necessary at the time. So I think this isn't really anything tradable. I'm not saying like go buy puts on Abbott, but I think this is one of those cases where like look, our system is kind of like the best what we have right now. But if you're someone that thinks that like corporations and companies are always going to have their customers' best interests at heart, like that's just not true.
SMH. That's all I can say.
And really these stories like this are just the ones that get broken and that we get to see. And there's a lot of other, things like that going on behind the scenes. So I think the more attention, the more scrutiny Abbott catches for this, maybe that'll make a big multi-billion-dollar corporation think twice.
I hope so.
The next time they do something like that.
I hope so. And on that light note, let's segue into our next guest today, Jake Wujastyk, who is from TrendSpider. And Jake was also at Fintwit over the weekend.
Hell yeah.
I cannot wait to hear what he thinks what the best part of the weekend was. Let's get his thoughts right now. Jake, long time no see, man.
Long time no see. How are you guys doing? Get back safe, I guess.
Yeah, same to you. Are you all recovered or still recovering?
So I was in Vegas from Thursday to Sunday, and compared to other times I've been in Vegas, I always lose my voice. So the fact that I haven't completely lost it was actually a big win. So yeah.
Mine's on the precipice here a little bit. Aaron and I went through our favorite moments of the weekend earlier on the show. Do you wanna tell us what you liked or disliked, for that matter, about Fintwit?
Yeah. No, I had a great time. Our team, Braden and Jason, were also there with me, so it was a great time. I mean, just being able to see people and meet people that you've been interacting with on the internet and never really talked to them in person is always cool to kind of make that connection. But yeah, overall a great event. You guys did a great job and a lot of great speakers as well. So I think a lot of people had a good time and looking forward to the next one.
I have to say, on Friday night, we were going out afterwards, and we were in a big group, and then you got separated. Well, what happened to you?
I don't know if you guys have had Honeydew on, but Honeydew is an influencer on Twitter, and her friend was with her. So I went to go meet with them since everyone was going pretty fast. So I went to get them, and then I think they were with us at Planet Hollywood. I don't know if you guys saw them.
Yeah, but then I got separated from everyone, and then I don't know what happened after that because I wasn't there. But
Blackjack was good to us that night, and then craps not so much, but all in all was a great time. And we had a big group that night. That was like 20 plus people. So
and to echo Jake's point, it's what we said earlier. I mean, the best part of these events is it's learning, but it's also just like the meeting of people, right? And just hanging out, people that you talk with all the time. So I'm glad you had fun.
So before we get to stocks, before we get to charts, Jake and I saw eye to eye on something in Vegas that I think Spencer.
You're a little far from. Can you, Mike?
Oh, sorry. I'll repeat. So I think so. Jake and I saw eye to eye on something in Vegas that I think Spencer disagreed with. I'd be curious to get the audience's take here because I strongly believe I'm right, and that in turn means that Jake is right. But essentially, it was that. If I budgeted, let's just say for hypothetical purposes, it was $500 for gambling. Say I ended up losing $700 throughout the weekend. I didn't really lose $700. I only lost $200 in that scenario because that's what I went over my budget.
Wait, when did I disagree with that?
I don't know. Maybe it wasn't you. Someone was like, no, that makes no sense.
I don't think that was me, man.
All right. So basically, the idea was just that the budget, you set the budget. You don't lose until you go over that budget. Am I right, Jake?
Yeah, that's how I look at it. I don't know if that's the right way to look at it, but people think I like my charts. I love budgeting. I've had a spreadsheet that I've kind of been working with probably since I was about 16. That's just all soft coded in. Like I'm very, very, very heavy budgeter, and so that's the way I look at money as well. If I budget something, technically it's already kind of it's already gone. It's already kind of part of the budget. So that's the way I look at it. That's how I can really justify, going and gambling. And I mean, you get it, you have to consider, if I got a couple beers while I was gambling, you go to the bar at the casino and that's going to cost you at least $10. So there's a lot of ways to kind of look at it. But for me, that is how I look at it for sure.
Jake, I wholeheartedly agree with both of you. I love budgeting. The moment I allocate something, it's gone in my head, and anything after that, anything that doesn't get spent is gravy, as far as I'm concerned.
Yeah, and if you end up retaining like if you gave yourself a $500 budget and you end up leaving Vegas only lost $300, that's a big win.
That's a big
you
win.
retained $200 of your budget.
It's a big win.
It's a big win. All right, Jake, have you had time to check out any charts since you've been back?
Yeah, well, thankfully, a lot of the charts that I have are still relevant from last week. So that's kind of sometimes fun on the chart side of things, where you can draw a chart and it's relevant for a while. So on the broad markets, I haven't really changed anything on this chart from last week. We still have that previous support zone that broke down. It's now acting as resistance. It acted as resistance last week, and then again. Today, we're kind of getting right along the bottom side of this zone. But one thing I wanted to point out here is the COVID low VWAP was definitely an area I think, at least I definitely was watching. I know Brian Shannon, he's kind of the father of the anchored VWAP. I know he was definitely watching it. But what's really interesting is, and this happens all the time, you'll notice that we literally bounced maybe like 50 cents above where this blue line is. And so this is really why zones are really important. Having a zone rather than just having an exact price level can either keep you out of a trade or get you in a trade, even though there's a little margin of error there. So if you are using TrendSpider and you do want to be able to track these zones rather than exact levels, just right click on the line. And this sensitivity feature would have alerted you when we got down there. So being able to kind of create these zones, not only with the trend zones that I make using the linear regression channel tool, but also with the alerts, you can add these zones to those as well. So all in all, it's a great way to just watch the market with a little less precision, right? You want to have precision, but at the same time, you also want to give yourself a little bit of room around resistance or potential support levels below.
Yeah, and I know a lot of people were kind of watching that COVID low VWAP as we were approaching it. So to see it end up bouncing from there was pretty remarkable, just in terms of like how accurate it ended up being.
Yep.
Any other? I'm curious if you have any takes on just Bitcoin's chart right now.
Yeah, I'm not sure if the last chart looked like on that one that I made, but I can spell. Sure. There we go. Yeah, I mean, Bitcoin, I think last week we were talking about Bitcoin and, how we may get that flush, and we did. So this is kind of the chart that I've got, a very basic horizontal support resistance. But the thing is, I drew this as a function of closes rather than candles. So you'll see here that, this is not respecting some of these wicks. So what I had was, I had the line chart. And so, once we started to break down through this line chart, you can see that we did kind of close below these previous closes. That's when you did have a little bit of that, what I call just a waterfall, because you literally waterfalled from like 29.5 to 26.3 or something in a short amount of time. So the fact that we are starting to break down below that again, I don't think is great. But it's Bitcoin. Sometimes on Bitcoin, you have to have a margin of error around some of these areas of like 10%. Whereas, on Apple or something like that, a 2 or 3% move in a day is a lot, where in Bitcoin, you can have that in 30 minutes. So to the upside or the downside. So the fact that we did kind of break down through this area, we do have quite a wick here. So, oh, wow, I guess we got to 25.3. Okay.
Yeah, that was just real quick overnight on I believe like Thursday night last week or something.
Okay. Yeah, so that makes sense.
It did not hang out down there very long. Came back up. But yeah, I mean, I think what's interesting here is, so we're kind of at this support, right? Well, I think it'll be pretty telling. I actually thought if we did dip below there, that like 26 level, that it would end up falling more than that. But I think because it came back so quickly, it didn't really stay down there very long. But if we say do drop below and we're trading at 26, 27, I think that's going to be pretty bearish for Bitcoin. Whereas if we can get above that support level and hang out there for a little bit, we could see a little bounce.
Yep. So, I mean, I think we touched on these levels last week, but your main kind of levels, I think, that are in play. One, the COVID low VWAP. We pretty much sliced right through that last week, closed below it. And then we literally went right down to that 2018 low VWAP, almost to the dollar. So, this 2018 low VWAP right around 25.5 is definitely going to be your make or break area. If we start breaking down through there, I think, things are going to get pretty ugly. And then on top of that, just to kind of look on a longer term view here, as bad as this looks, or what people may have thought, with this being at 69K, I mean, look at the longer term chart. We're still hitting higher lows. So, 29.4 may seem crazy low compared to where we were, but I mean, compared to where we started at 4 years ago, this thing is not doing too bad. Now, I don't know if that, if we're kind of lagging a little bit here. You do kind of have a rounded top that's been forming for quite some time. So that's definitely something to keep in mind on the maybe medium term kind of weaker side of things. But let's see. I'm actually curious. I don't think I've thrown a volume by price chart up here in a second for Bitcoin. So from the 2018 low, you just don't have a lot of participants here. There hasn't been a lot of activity within this area compared to, at least, this area down here around 10K. Then you've got another little volume node blip right here around 38.5 to 40. So we are kind of a little bit in this, if you call it kind of a vacuum, if you will. There's just not a lot of trading activity that's gone on in this area since 2018. So a lot of the time, price can move very quickly down through these areas. But what you can also have is other volume nodes essentially being created, right? So like, as price action is occurring, you may not have a lot of volume here now, but if all of a sudden you've got a lot of volume, we may get one of these little things that pop up here, because over time, this volume by price profile is changing. So we'll just have to see what happens. But for now, you do not have a ton of activity in the past, centered, let's say, around 30K all the way down to around 14. You can see here, the reason is because we moved up so quickly from here to here. So there wasn't a lot of time for volume to aggregate within that area when we were moving straight up for like 5 months. And then obviously, the more that a price is going to trade around a level, the more volume there's going to be there. But we are entering that area below that may be a little tough to hold if we do break down below this VWAP from 2018.
Got it. And let me see if we have some other tickers from the chat. Ricky's asking about AMD. Have you checked out AMD at all?
I mean, I have my my stock app that I always kind of am looking at. So I have been watching AMD. It's it's holding pretty decent on the monthly chart. If you essentially anchor the volume by price from this April 2018 low, that's kind of your reversal point before we hit new all-time highs. You do have a decent amount of volume kind of supporting price here. So you can see prices kind of hanging out right at this volume shelf is what I like to call this area, just an aggregation of a lot of these volume nodes. So for now, it's actually holding pretty well. Now on the daily chart, we are kind of in a pretty big channel here. So what I had the volume by price measured from the all-time high And you'll kind of see here that we're hanging out right below kind of what we just had on Bitcoin, but the opposite, right? So on Bitcoin, there wasn't a lot of volume below it. Now you don't have a lot of volume above AMD until we get to around 107.50 to around 109. And then you'll also see that with this resistance zone, you kind of have this confluence here between this break-even supply zone above and this resistance zone above as well. So if we did continue to move up from around 114 all the way up to around 118, 119, you're going to have a lot of supply. A lot of people are stuck from the 115 to 119 area. So the more people that are stuck, once they get back to break even, they're likely going to maybe take some off the table, sell some, or the whole position, and that's what adds supply onto the market. That's why I call this break-even supply, because all of these shares are currently holding at a loss. Once we get back up to that area where these shares are holding, some people are naturally just going to take some off the table or just exit the position fully, and that's how it acts as a supply zone.
Got it. Yeah, I mean, it's hard right now because some of these semi names, whether you're talking AMD, Nvidia, are still expensive by a lot of like fundamental metrics, and those are the ones that have seemingly been getting hit hardest in this most recent like growth crush. But I also think have the potential to have some of the bigger upsides whenever we do swing around. So I'm watching Nvidia and AMD here, but I haven't really been trading them much recently at all.
Yeah, I mean, it's down almost 50% less than half a year. So it's definitely, that's quite a big move to the downside. And then it's always interesting when you have this on log scale, it looks like this is your 50% move down, compared to where this was at. Most people who bought this in the 2018s, even 2019, are doing just fine. And so when you do use if I turn off log scale, notice this is how it looks. So when you have this big of a move, meaning pretty much from where we started here to here, that's like an 8,000% move in like 6 years. When you have that big of a range on the chart, you generally want to switch it over to log scale, just because there's such a big range. You don't want $1 at, so if you have when AMD was like a $2 stock and it went up $1, that's a 50% move. Now $1 move is barely anything when it's at $95. So the log scale kind of accounts for that and makes the y-axis more of a percentage change rather than just a dollar change. Because as I mentioned, you can't weight $1 move up here the same as you can down when it was at $2. So that's why I use log scale a lot of the time, because most charts that I'm looking at do have it over a 20% range on whatever time frame I'm looking at on the chart. So that's kind of my rule of thumb. I learned that studying for the CMT. So that's kind of the way I look at it, and that's kind of where I learned it. That reason.
Yeah, I like that. I never really look at those log charts, but it shows you, it's just showing you where more volume is, right?
Well, this is volume by price. The log chart makes the move on the y-axis a function of like how much percent. So like if this moved up 10%, a 10% move at 95 is $9. A 10% move at $2 is 20 cents. So it just kind of accounts for.
I see.
So it's a way to kind of capture these bigger moves, but apply a $1 move or a $10 move differently than it would be, 90% lower.
That makes sense.
So that's and that's just kind of a rule of thumb that the CMT association kind of uses, and that's kind of where I've taken that logic from.
Hell yeah, I like that. All right, seeing if there's any other tickers in the chat, or Jake, obviously, if you have any charts you came prepared to talk about, let's run through those real quick.
Yeah, I mean, MU is always one I like to watch, especially when AMD and Nvidia are maybe looking like they've got some type of bottom forming, but we're on the monthly here, and you don't really have much action over the last really almost 2 years. You just have been trading in a pretty tight range. So if we just kind of draw this area here, we haven't really moved much. So this is one that I'm kind of keeping an eye on. When AMD is kind of forming maybe some type of bottom, this is one to always look at it. It does move differently than AMD and NVIDIA. It's not that uncommon to see AMD and NVIDIA up quite a bit, and MU just is in its own little world. So this is one I'm kind of watching. You can't even really look at least the weekly candle right now because we're on the first day of the week. But you can look at the weekly candle just to get an idea of, and looking back and see what that longer term trend is. But yeah, it doesn't look horrible. And I think another one is XOM. This is one that's definitely had some legs. The one thing I will say about XOM is you are kind of getting close to the resistance zone here on the weekly chart within this ascending wedge. But so far, it's been a very strong day for XOM. It's up 3%. So this is one, I mean, this isn't an uptrend. Not a lot of stocks are in uptrends right now. So if you are looking to go long on something, look at the ones that are still in an uptrend. So yeah, that's definitely one I'm watching. Amazon is actually at an interesting level right here as well. So you can see here that, we broke down through this long-term support a few weeks ago. But you have this 2018 to 2020 kind of resistance zone that acted as resistance from anywhere from around 2000 all the way up to around 2200. So the fact that we broke down, have a decent weekly hammer here is one thing, but not a great start to the week as far as what this weekly candle looks like. But it's only the first day of the week. A lot can change within 4.5 days. And then on the daily chart, you can kind of see here that there's not a lot going on here other than just straight down pretty much from earnings. So some people may consider this a potential V bottom. I would probably wait a little bit before I thought that was the case. But all in all, we are holding higher lows than we had last week. So that's something to consider. But I think interest rates are just kind of moving the market right now. So keep an eye on interest rates. When interest rates go up, that's not incredibly good for the markets because then you get a better return in kind of fixed income assets. And instead of having to put your money and risk it in the market, you just put it in a bond or something that actually has a return now, or the 10-year. So interestingly enough, we talked about this last week where we were breaking through this resistance zone, this 40-year resistance zone, and not really shocking to see us kind of pull back and retest that area. So this is something you definitely want to keep an eye on as the markets are doing their thing here for sure.
Yeah. And I think from like a macro perspective too, we're looking at the bond yields, oil, and everything. It's so interesting because, well, finally, at least the 10-year note you can see is spiking up, but the 20-year bond note hadn't really been, which a lot of people were surprised by, saying like, okay, why isn't the bond market kind of pricing in this recession? And the same thing with oil, because typically in a recession, like demand is crushed and oil ends up actually getting cheaper because people aren't flying as much, people aren't driving as much, whatever it is. So I don't know, things like people keep comparing this to either 2000, 2008 or whatever. I don't know. To me, like things are different right now than those other two times we had tremendous market weakness. I don't know if you really follow a lot of the macro stuff, or if you're more just looking at charts trying to see if there are any trades setting up.
Yeah, I mean, I follow the macro. I mean, one thing I'd mention with oil, it's denominated in US dollars, right? So as the dollar gains traction, technically that should actually hurt demand for oil as well, because whoever has to exchange their currency into USD is actually getting hit. So the dollar becomes more expensive, and so does oil because of that. So that's something to also keep in mind with all of this, which is interesting to see that oil just keeps going up. I think it's just a really big supply issue. So when you've got supply issues, some of these things that generally move the market, or the logic behind the moves, they're just out the window. Kind of like seasonality, right? Like seasonality is great, but times like these where they're kind of unprecedented, or at least haven't happened for a long time, sometimes those statistics kind of go out the window until the market can stabilize a little bit.
Yeah, and I mean, if we're talking about the dollar, if you want to pull up UUP real quick, we can see how strong that's been over the last 3 months, and that's kind of showing the US dollar compared to other foreign currencies, which is the other part that some economists are pointing to, saying like in times of recession, the dollar becomes weaker compared to other currencies. Right now, the dollar is becoming stronger. So, like I said, like I think there's just a lot different right now than what happened in 07, 08. I think definitely could be some more tough times ahead, but I don't know if it's to that extent, that scale. I don't know about you, Jake, but I'm ready for these oil and gas prices to come down. I filled my tank up this morning at 480. I know the flights were expensive, you know, from rising jet fuel costs. It's got to come down eventually, right?
Yeah, I mean, you know, this type of move up in prices is essentially like a needle in a balloon, right? It can happen very quickly. You know, all of a sudden people are like, all right, I'm just not paying these prices. You know, and I mean, when we were in Vegas, there were quite a bit of people there. So it seems like, you know, maybe we haven't gotten to that point quite yet where you're really starting to see, you know, a change in demand. But at the same time, a lot of these people probably bought these hotels, you know, 6 months ago with their flights before those oil prices kicked in from I'm just going to call it supply. I mean, some people are saying it's because of the war didn't help, but gas prices were already on their way up, well on their way up. So I think you do have a little bit of a lag there because a lot of people are, you know, booking stuff in advance. It's not like a lot of people just randomly probably booked to go to Vegas last week. You know, they probably had that already in their, you know, in their plans. And so maybe 3 or 4 months down the road, when people are probably starting to look at trips to Vegas or other places now, you know, they may change their spending habits a little bit compared to in January before we really had that huge spike in costs and oil.
Yeah, and I know it's not, you know, empirical data or anything, but I do think it's interesting. Like you hear the polls right now where the number one concern is about inflation in the economy, and then like you go to Vegas, it's pretty bumping. Like these people didn't seem to get the message that we're in a recession or whatever. And it's like, it's not just Vegas. Like you go to Target on a Sunday, whatever, you know, and it's like, there's still consumer demand out there. And that's where I think really the outlook right now, as far as like the macro standpoint, is very different. That a lot of our problems right now are kind of obviously supply driven, not demand driven. Mm-hmm. And the Fed, I mean, Jerome Powell's even said this, hey, we can do something about demand. We can't really do anything about supply, you know? Yep. So that's we'll see. I think as long as demand stays high, we'll see high prices until hopefully the supply chain is figured out, specifically with oil. Because that's what's the cost of oil is increasing the cost of all other commodities, because of course you need the oil to ship the steel or ship the wheat or whatever it is. So yeah.
I agree. I mean, oil's the underlying factor for a lot of these, you know, prices. So price increases. So we'll see. I mean, you know, it will get to a point where even if we still have supply constraints, people are not going to pay, or they're going to have to pay, but they're just going to have to cut back on a lot of other things if oil does, or if gas does go to $5, $6, $7. And it's already there in like, you know, California and some of these other places, but you know, Denver, I think we're still around $4 for just regular gas. It definitely goes up if you've got higher octane gas that you need. But yeah, I mean, it's going to get to a point where people don't really have a choice. They're going to have to cut back. Where now we may just not be at that area where people have to make a choice if they can spend an extra $20 at the pump or not.
Yeah, I mean, you're gonna have your things that people have to buy: gas, rent, food.
The same thing with the real estate market, right? Like everyone's thinking, well, yeah, I'm just waiting for prices to drop, and I'm waiting for, you know, the market to crash in the housing market. Well, that's great, but as interest rates go up, the $50,000 that you had to put into your house or put into a mortgage, now you're required to have even more money, because, you know, the lower the interest rate, the less money you need to have to, you know, for getting a mortgage. So that, and if we're in a recession, all of a sudden people who were just waiting to buy a house may not be able to buy one now. So I mean, it's all supply. At least in Denver, it's a supply issue. It's not. There's a lot of demand, but demand is definitely, I think, cooling off because of these interest rate, mortgage rate increases. I think they've doubled from when I got my house. Talk about like my best trade. I don't even think my best trade.
Best trade of your life, man. Best trade of your life.
Buying when my wife and I did was probably a better trade than anything I've done in the market. But
well, and in that sense, the fact that a lot of people have gotten their mortgage rates locked in the last couple of years before they rose, in a way, like housing for you as mortgage rates rise right now.
It's an inflation hedge. Oh, that's where you.
Well, no, I was going to say it's like housing's actually becoming cheaper for you right now, not actually out of your pocket, but in relation to the interest or the mortgage rates rising. Your housing is staying, you know what I'm saying? So it's like becoming cheaper for people that have gotten their mortgage rates locked in before this recent hike.
Yeah. We'll see what happens. I mean, I was talking to somebody at the event, and they said, I don't think, he pretty much said if inflation stays at 8%, then rates are going to have to go higher than that to combat that. That was an interesting take. But if that's the case, we still have a little higher to go on rates before things really may take a turn on the inflation side. But yeah, this is definitely unprecedented. In my life at least, I don't remember ever worrying about inflation or people talking about inflation like this. So it's definitely unprecedented.
Sure. Jake Wujastyk from TrendSpider. Jake, it was great to finally meet up with the weekend. Have a good rest of your week, sir.
Hey, you too. Thanks, guys.
All right. Let's bring on our.
Wait, Spencer. I had one. Well,
yes.
Actually, I can do it after.
You can do it after?
Time we have. Yeah.
All
I have
right.
one super quick thing.
I wanted
to talk about.
All right. Well, let's save it for after our guest. New guest we're going to bring on today, Randy Frederick. He's the managing director of trading and derivatives at Charles Schwab. Because he's a new guest, we'll give him one of our extra special intros. Randy Frederick, welcome to the show. How's it going today?
Good afternoon, gents. It's great to be with you.
Great to have you. Randy, I was going through your note that you do. You put out a note every Friday.
Right.
And I couldn't help but notice that at the very beginning of your note, you had all of these stats about the number of EPS and revenue beats that we've seen from this most recent earnings season that we're just now coming out of. I have to ask, does that matter at all?
It matters a little less right now. Right now, obviously, everyone's focused on what's going on with interest rates, what's going on with inflation. But earnings ultimately are, the basis of capitalism and the capital markets, right? I mean, ultimately, no matter what, when you make it as simple as possible, people buy stuff, they buy companies, hoping that if they're not already profitable, that someday they will be, in which case they'll share those profits with the investors, either via dividends or ultimately you sell it at a higher price, for capital gains. The only reason a growth stock goes up is because there's a belief that somewhere down the road it'll make a profit eventually. Sometimes that doesn't ever happen, or it's a company that's currently making profits. So yes, earnings matter. There are times when obviously they matter a whole lot more than others. We've just come out of an environment where really geopolitical events have been driving everything, or prior to that, it was the COVID virus, and now it's all about inflation and interest rates. So it still matters. It's just, it's a secondary or a tertiary issue.
Yeah, I was being a little bit tongue-in-cheek there, but also kind of serious.
Well, I really liked Randy's response because that's how I anytime I have a friend or family member, my mom or someone just be like, I just don't understand the stock market. Like the most simple way I can put it is you're buying, you're buying shares to get exposure to those future earnings. So it's all about, how much these companies are making and the potential for them to make more when you're talking about growth companies. And on that note, I saw something yesterday about how Facebook in 2006, maybe it was 2007, but before the kind of financial crisis, raised like $100 million at value. The valuation was like 100 times price to sales, whatever it was. And Facebook raised more money 2 years later. The company had grown, made more money, but that time the valuation was only like 13 times. And it was just because the macro environment was different.
Right. And earnings multiples, trading multiples, whatever we're willing to pay for a company. I mean, it's our belief, our confidence, our optimism, if you will, in how strong we think that company will be. Last year, was an extraordinary year. Every single sector of the market went up. Even the worst performing sector was up double digits. The only way you could have lost money last year was if you shorted the market. This year, depending upon how long you've been around, I'm an old guy. I've been around this business for well over 30 years. So I remember not only the 2007, 8, 9 meltdown, but also the one that happened, between 2000 and 03. And this feels a lot more like that one because we don't have, esoteric mortgage-backed derivatives. We don't have all the shenanigans going on in the banking sector and on Wall Street that we had back in 08 and 09. The banking sector is very solid. It's very strong. And then I know you guys have been talking about this just earlier. The consumer is still very strong because we're coming out of one of the biggest phases of fiscal stimulus that we've ever seen before. While some of that money is certainly running out, we do know that credit's rising, so people are spending their savings. But ultimately, one of the biggest challenges we have right now, and really it works to the benefit of the Fed in this interest hiking cycle, is the fact that the consumer is still very strong. We complain a lot. People love to complain, and sentiment gauges have gone to the basement. But when you measure what's actually happening, in other words, behavioral activities, not sentiment activities, or not attitudinal measures, you see that people are just complaining a lot more, but they're still spending, traveling, going to restaurants. When I can't get a place at one of my favorite restaurants, it's booked out for 90 days, and that's constantly the case, then I'll believe that we're truly heading into a recession and that the consumer is actually altering his or her behavior. We just really don't have a whole lot of data that shows that right now.
I agree.
Because you mentioned the two prior recessions, I do think it's helpful to zoom out for a little bit, Randy. And it seemed to me that the real concern here is that we get a repeat of that decade, right? The 2000 to 09, which is basically a lost decade for investors. Now, those of them that were patient ended up being rewarded with the decade after that, but that was a rough 9 years, right? You basically went nowhere, and that seems to be the concern now. Like, oh, is this like another one of those situations where it's like 9 years of nowheresville? Is that a fair assessment to you? Especially coming off of the decade we just had, which was unbelievable for most things, not everything, but for most things.
I'd say yes and no. It was true if all your assets were in the technology sector. The NASDAQ is only really the sector that got crushed for a decade. If you were broadly diversified, which you should be, and the reality is because technology makes up such a large part of the market, it's about a quarter of everything out there. Most people, whether they know it or not, are probably way overexposed in technology because if they own things like SPY or QQQ or DJI or any of these other broad-based ETFs or mutual funds, they probably own a lot of the same stocks that they own individually. Companies like Apple and Microsoft and Google and Facebook and things like that, they're probably overly concentrated. So yes, strictly talking NASDAQ only, which is now in a deep bear market, down 26, 27%, whereas the S&P 500 only down about 16%, still just in correction territory. That's why we constantly preach about being well diversified and having your assets spread out across some of the more defensive sectors, which this year, as you can see, are doing very well. Staples, utilities, those kinds of things that aren't too exciting or fun to talk about. But in times like these, you're good. You're glad that you have them.
So I'm just curious what you're bullish and bearish on right now. We can go sectors, we can go industries, we can even go asset classes.
Well, as a company, we've put out a neutral rating on all sectors, which is not too helpful. I understand that.
That does nothing for me, Randy.
It doesn't help. I know. This is a tough environment because, historically when equities are getting crushed, you could go and hide in the bond market. Well, the bond market's getting crushed too. So then you go hide in gold. Well, gold's not doing all that well. And lately, the new digital gold cryptocurrencies is a place where people go. Well, of course, they're getting beat up there. About the only place that's done okay and is holding in there is what you were just talking about with your previous guest, and that's the real estate market, hard assets. Real estate, while it's certainly going to cool and is probably already starting to cool, certainly the refi activity has dried up entirely. It has done extremely well. It has outpaced inflation. It's about the only place I can think of that has. Even cash hasn't been done well because the payment you're getting on cash holdings is not coming close to keeping up with inflation. So this isn't a unique environment. What you do here is you stay in everything that you're in. You make very small tweaks around the edges. You look for stocks that are big, solid companies with strong balance sheets that are profitable, that you know are going to be here a decade from now. And you pick up small quantities of shares on these down dip days that we have so that you can build your long-term asset and lower your cost basis overall. That's what you do in an environment like this. Maybe when you get a few of these erratic up days, which we occasionally get, you get some of the biggest up days in markets like we are in right now. And in fact, just go back the last 3 weeks, we've had several 1.5%, 2% plus up days, even as we've had 2 and 3% down days in between. Then you take small profits off the table. You don't sell out of everything. Getting all in or all out is a terrible strategy, but you make, little 1 and 2% in and out moves along the way. And then you just have to wait it out. It's not fun and it's not exciting, but this is a more normal market than what we've seen last year, especially.
So you're referring to people who want to take longer term positions in things, buying on the red days, taking short term gains on the green days. The problem is there's an awful lot of red days though, Randy. So I mean, I can imagine somebody who wants a dollar cost average into. I'll give you an example for me. So I like Shopify. I took a stab, got stopped out. It is what it is. I would love to buy it again, though. It keeps on falling. So I mean, yeah. No, I know you can't speak to specific stocks, but I mean, just as an example, it's a stock I would like to own, and it can't stop going down. So like, what would you say to someone in my position?
Well, so there are a couple of things you can do to make this whole process work better. First of all, I want to reiterate, everybody needs to be a long-term investor. I'm the trader analyst at Schwab. Yeah. That doesn't mean you should trade your entire portfolio. One of the key statements I make for every event that I've been doing for over 20 years now is that you should all be investors. If you want to be a trader, great. Carve out 20% of your portfolio. That's your active trader portion. The other 80% has to be dull, boring, diversified, long-term ETFs, mutual funds, that kind of stuff. Yeah. That's okay. You can do a lot with 20% of your portfolio. So 2 ways to do what you're talking about, and this isn't a specific statement on Shopify at all, just any company like that. Couple of things you could do. First of all, in the last couple of years, commissions have gone to zero. When I started in this business, we charged $80 for a round lot, and that was dirt cheap relative to Wall Street. Now it's zero. There's no reason not to trade in small little tiny lots. You can buy 1, 2, 5, 10 shares at a time. And in fact, if you want to own, say, a round lot of a company, put in 10 limit orders for 10 shares at successively lower prices. As it dips lower and lower, you'll eventually accumulate at a very low price. That doesn't mean you'll immediately make money, but if you are willing to hold that stock for the long term and you're confident that it's a stock that's probably going to go up and eventually, then you can lower your basis that way. Another interesting and kind of clever way to do that, if it's a company that trades options, and most of them do, is you can sell put options down below the current price if you're willing to pick up 100 share lots at a time. And in those situations, now, because volatility is elevated, the market's not doing well, those options are priced very favorably. You can get a pretty nice premium for those. That is a way of getting paid to enter a limit order, or essentially about the same thing. Then if the stock dips down, you get assigned at a nice price, you pick up some option premium in the meantime. And if it doesn't dip down, then the option expires and you can do it again. Those are a couple of ways to sort of modify your trading in a way where in the long run, it will ultimately help out.
And so
100 shares of Shopify. I'm not quite there yet in my account, AB.
What would that be? 3,600.
Well, and maybe not on Shopify. Maybe there's probably some other stocks out there like that one that you are interested in that have been beaten down from say 100 share, maybe to 20 or 30 dollars.
I'm just messing with you. Yeah.
So Randy, you mentioned that option of selling the put options. Is that kind of like one of your roles at Charles Schwab, acting as kind of a market maker, selling these option contracts?
We're not a market maker, no, but I am the options analyst here. So I teach people how to trade options, and I teach all sorts of different strategies. That's a strategy that you have to be approved to trade options, which is not that difficult to do for most people. If you've been investing in stocks for a few years, you could probably get approval to do short options like that. And we're not talking about leveraging here. We're not talking about making selling options for stocks that you can't afford and doing what's called a naked option. We're talking about, let's say you want to own, 100 shares of a $10 stock. That's, that amount of money then gets set aside. And instead of actually buying the stock, you sell the put and then you sit tight, and that money just sort of sits off to the side. So when you get assigned, or if you get assigned, the money's there available. That prevents you from ever being forced to buy a stock that you can't afford or losing money that you don't have. It's no riskier than buying the stock outright. It's just like entering a limit order, only you get paid a little bit when you actually put the trade on.
Yep. Randy, I'm just curious, like, what are you seeing from your clients on the options side of the market here in terms of, activity, calls versus puts, open interest, et cetera?
Yeah. So last year, or in fact, last 2 years, 2020 and 2021 were extraordinary years for the options industry. It grew faster than it's ever grown, although it has grown pretty much for the last 25 or 30 years. with about 1 or 2 years exception. But the last couple of years have been pretty amazing. When COVID shut everything down back in the spring of 2020, one of the few activities that people could do was stay at home and trade. And one of the reasons why we see a lot more people in the markets than we did previously. In some cases, those people went into the options markets. In other cases, they went into crypto. In other cases, they went into meme stocks. For the most part, a lot of that stuff hasn't worked out all that well. A lot of the very high-flying meme stocks have dropped 60, 70, even 80% in some cases. Speculating on options by just buying call options outright is a really tough way to make money. Buying a long call seems really simple, but making money on it is not simple at all. There's a lot of things going on. It's just as easy as buying a call, and if the stock goes up, you make money. You got to know that it's going to go up. You got to know how much it's going to go up, and you got to know how long it's going to take to go up. Those are difficult things to forecast. So the volume in options exploded throughout that time because there wasn't a lot of other things going on. But eventually that cooled. The peak, in fact, for options volume in history was in November of last year. The second busiest month was in January of this year. Things have been cooling off a bit since then. Obviously, since the second day of this year, the market has been trending lower. And as a result, we've seen option volume diminish a little bit, mostly on the retail side. But overall option volume is actually hanging in there pretty nicely if you add all of the other players out there. Not that it's at a record high level, but levels just in general across the board are at a much higher level than they ever were prior to COVID. And I'm not sure that they'll ever go back. And part of the reason for that is even some people who lost some money, hopefully didn't lose all their money. Now they're curious. They want to know more. They want to get educated. They want to learn how the markets work. They want to figure out that there's ways to actually invest and it's not just speculating. And so I think that's been a good thing overall for investors across the board and not just options traders.
Yeah. And I'm just wondering as well, maybe over the last 6 to 12 months, have you seen that sort of behavior just reflected in maybe less, how do I want to put this, less like crazy short-term, buying short-term call options out of the money, and maybe more like, oh, tell me about like this SPY thing, for example?
Yes, absolutely. That's kind of what I was alluding to earlier. Since the beginning, especially since the beginning of this year, like I said, January being the second highest month, for the last 5 months, it has been changing a little bit. We've seen the what I call irrational bullishness sort of dwindle away. Not that people have gone bearish, because they really haven't, but they've gone from more of a what I would call, so bullish that it becomes contrary, which is, people are so ridiculously bullish that they think there's no way the stocks can go lower. We heard this last year, right? Investing's easy, stocks only go up. Well, that's not true if you've been around long enough to have lived through a bear market. Unfortunately, a lot of today's investors have never been through a bear market. I've been through a few of them. So you learn a lot. You learn a lot about yourself. The one thing that most people learn that they don't think they'll learn is that their tolerance for risk is probably substantially lower than what they think it is. Everybody says, oh yeah, I can live with a 15, 20, 30% drawdown in my total portfolio, no problem, until it happens. And then you realize, dang, this is no fun. And it's not. So yes, we have seen people get realistic. We've seen another uptick for people clamoring for education. And I've seen this throughout my career because I've been teaching options for most of my career. Every time the market goes into a downturn where all of a sudden isn't easy to make money anymore, that's when people decide I better get educated so I can learn how to use options for the right purposes. How can I generate income when the market's not going up? How can I protect my positions when the market's going down? Those are things that you can do that people don't think about except when they need them. So it's kind of like buying, you don't want to wait too long. So you can't really buy insurance on your house when it's already on fire. But that's kind of the mentality, unfortunately, that some people have.
Yeah. And so Randy, I'm kind of the quintessential millennial, stereotypical Gen Z trader that got interested in options. Well, actually, I downloaded Robinhood and started trading options like January of 2020. So this speaks to your point that options had been growing in popularity before COVID, before we got to these crazy markets. It just happened that I got into it like 2 months before the craziest market of all time. But my background is more in media. I've just always been kind of drawn to finance and business and trading. And honestly, like as someone who doesn't have a background in finance, just the word derivatives has always been kind of one of those like, what's the easiest way you explain to someone what working in derivatives means like in real practice?
Well, it's a great question, and I've heard it thousands of times, so I've got a really good answer. It's this. To me, the term derivatives is extremely broad. And the analogy that I typically use that people understand, because the best way I can explain anything is in terms of things people already understand. A derivative is the same as a vehicle. If I say vehicle, what do you think of? Well, some person might think of a car, Some person might think of a train, a 747 jumbo jet, perhaps a bicycle or a skateboard or a scooter. All of those things are vehicles. But the difference between a little electric scooter that you run down the sidewalk and a 747 couldn't be more possibly different. They're different night and day, not knowing in terms of how many people they can carry, how far they can go, how fast they can get there. That is how broad the category of derivatives is. So my area of focus for most of my career still is on the options markets, mostly because options markets are standardized, they're fungible, they have a very vast and very well-developed regulatory network. They're easy to trade, they're highly liquid, lots of exchanges, clearinghouses, regulations, very, very standardized. I can buy, there's 14, 15 different options exchanges. I can buy one on any one of them, sell it on any of the others. It's the same contract, it's the same thing. That's one of the keys to almost any investing. Any investment is you want liquidity. You want the ability to get in and out. Buying a rare coin or a piece of art or an antique Ferrari is great, and you might think it's worth a certain amount, but it's only worth however much you can find someone else is willing to pay you. When you've got a very liquid, deep market with a very tight spread between bids and asks, it's very easy to get in and out of everything, and that's what I'm looking for my investments and for things, especially that I want to trade actively.
God, I like that explanation. So it's kind of like you have the derivatives umbrella, which includes all these different vehicles like you're talking about. You have options, futures, you name it.
Yep.
But you're working mostly just in the options market.
Yeah, and where it gets tricky is that, especially when you think back to 2000, 2007, and 2008, people remember that, these crazy, mortgage-backed derivatives that people on Wall Street were selling that they didn't even understand, or what crashed the market. I'll never touch derivatives. What they don't understand is, you're talking about, a three-wheel bicycle. I'm talking about a 747 jumbo jet. These are both vehicles. Again, they're not the same thing, and it's a very broad category. And people who say, options are only risky and for gamblers and that kind of craziness, that's mostly out of ignorance of not really understanding the product and not understanding that it's just one of a vast array of products, many of which are over-the-counter traded, that don't have a whole lot of regulation, that don't have a very liquid market. And there's a lot of that stuff out there. So that's why it's best to sort of stay with standardized. Again, it's like the difference between trading, a blue chip stock that does 10 million shares a day on New York Stock Exchange to trading, a pot stock on the OTC pink sheet market that's 12 cents a share. There's not a lot of similarity there, but they're both stocks. They're both publicly traded companies. So you have to understand that wide array of products that's out there.
Lord Byron in the chat says he's describing me exactly, and so many bets saying I like Randy. So all right,
I like Randy.
We gotta get Randy back on the show.
We gotta get Randy back on because I could probably learn something from Randy as someone who's just been trading options for a couple years, and but I do like to learn. So, but I'm curious, when you saw or as you've seen this kind of increase in options activity or options interest. Is it something where you're like, oh wow, this is great. I've been working in this. Now more people are getting interested in the field I've been in. Or are you like, oh, holy cow, some people are going to get into options trading that maybe shouldn't be and lose a lot of money?
Well, both really. I got into this business back in the late 1980s, and so that's a long time ago. And the options industry got started in the early 70s, so it wasn't very old at that time. There were 4 options exchanges. Now there's, like I said, 15. I don't know. There's a new one coming on all the time. The volumes today are many, many fold what they were back then, mostly because of automation. That makes it a lot simpler. But the best part about now is the fact that, you don't have to call a broker to place an order. You don't have to get education. You don't have to pay a lot of money to go to these seminars that a lot of these companies that used to do that don't even exist anymore. You can get great quality education. The main thing is make sure you get it from a reputable source. One of the challenges with people like these meme stock traders is they go to some chat room on Reddit and they get this advice from somebody who doesn't even know as much about investing as they do. Talk to somebody or read content. I've produced thousands of articles, videos, you name it, on all sorts of topics relating to options trading, active trading, more recently, some of that stuff on crypto related things. We work in an industry that has a lot of regulation and the standards for what we can say. I can't promise you that you're going to make $1 million next month trading options, but there are all kinds of people out there who will do that. And it's just not true. What I'll try to do with everything that I talk about and everything I teach is to present to you a balanced perspective. And every investment is a trade-off. If you want this, yes, that's possible. but you have to be willing to compromise this. In other words, I want to make this much. Okay, that's fine. As long as I'm willing to give up everything beyond that. Or I want to protect myself down to here. That's fine, as long as you realize it's going to cost you a little bit. All those sorts of trade-offs, that's the most important thing of all. I mean, anyone can be blindly, constantly bullish or blindly, constantly bearish. That's not very helpful to anyone. What people need to understand is that you have to be realistic. You have to realize that everything is a trade-off and a compromise. You need to know what's real and what's possible. And one of my final comments I make for almost every seminar I've ever done is basically this. Look, investing is not about getting rich quick. It's about getting rich slowly.
How often do I say that, man?
Here's the thing, people are always looking for a shortcut. And I often tell you, look, if you spend as much time just focusing on long-term slow growth as you did trying to find the shortcut, by the time you figured it out, you'd be there. And a simple analogy is, look, these guys, a person that spends $10 a week on lottery tickets, give me your $10 a week and I'll buy, a fractional share or even one share of the SPY. And 10 years from now, I'll come back to you with a couple $100,000 and you will have nothing. That's the reality of it. Very few people are fortunate enough to roll snake eyes or to hit that one single number on that roulette wheel or pull the jackpot on the slot machine. But virtually all of us have the ability, if we're long-term focused and disciplined and invest small amounts over our career, to be wealthy when we retire. It's actually a reality for most of us, but it takes a lot of long-term thinking and a lot of persistence. And many people just don't have the patience for it, unfortunately.
Couldn't agree more. Randy Frederick is Managing Director of Trading and Derivatives, as we've learned, trading in vehicles is what we start calling him now, at Charles Schwab. Randy, it's been a pleasure to talk with you. We definitely have to get you back on sometime again soon. Have a great rest of your day. Great rest of your week.
Happy to come back
today. Mm-hmm. All right. That was great stuff. And so, speaking as a person that also thinks of analogies in my spare time, that's a very good analogy he made on the derivatives equals vehicles thing.
Oh, I thought you were going to say the options market being the casino.
No. I live my life in just one analogy to the next.
I wonder what Randy would think about me having my kind of two separate portfolios. My long-term investing, that's very, sound, I would say, and then my Robinhood portfolio where I have no problem making YOLO calls, but I'm doing it. I basically treat it like I am at the casino. Like if I put $500 on some BABA contracts that expire this Friday, which by the way I did today, that's not $500 that I consider myself investing. It's $500 that if I lose it, I lose it. If I make
Is that what you want to talk about?
Huh?
Is that what you're going to mention before, Randy?
No, I was going to mention it was crypto related.
What was it?
It's basically just the irony of the fact that these stable coins, or at least Terra,
not so stable.
Well, obviously that, but I don't know if you've been following kind of recently, Spencer. But there's been some days where I think Terra Luna dropped to 8 cents or something, and then went up. Like one day it was up like 300% from the bottom, and so now the stable coin has become the YOLO trade. It's become the crypto that it's not like Dogecoin anymore. You can make 300% in a day. It's this stable coin that's not supposed to move. This is the new YOLO trade.
Right. I was having this conversation with, and I don't remember his name. I'm sorry, but he was at our conference. He wasn't an attendee though. He was one of the AV guys. He was one of the guys doing the AV for us at the hotel, and we were talking about this on Saturday. And he said he was buying Luna. He asked me if I thought Luna was going to come back, and I was like,
hell no.
I was like, what?
They could offer 50% yield. It's not coming back to $1.
So then I was like, why do you care? And he's like, oh, because I just bought some Luna. And I was like, why did you do that? And he said because it's basically a lottery ticket, because whatever it was like 0.0008 or something, whatever it got. He was like you could buy 100 of these things for like $1.
I know, that's what I love. It's the irony of the crypto market is like the stable coin has become the YOLO.
So I was like, all right, listen, as long as you know that for the price of a Subway sandwich, you're gonna get 5,000 Lunas, and you know that you're probably gonna lose those $5, fine. Have yourself a ball.
Yeah.
You know what? I mean,
so that was my only point. I just thought it was funny, ironic that this has become the new YOLO bet in crypto. Your point reminded me. So at the conference in Las Vegas, so I had an Uber driver who, what are you in town for? A conference? What's the conference about? Was talking to me all about crypto investing, stocks.
Yeah.
And then last night on my plane ride, guy on the plane next to me is reading Peter Lynch, Beating the Street.
Okay.
And he's like into the book on the plane. Like there's like a table on a page and he's flipping the book with a highlighter.
Nice.
Yeah. I don't know. I've never read any Peter Lynch. So
I was online to get food this is on Thursday, and I overheard the guys behind me talking about crypto. It's everywhere. All right. So unfortunately, no moon or bust today. But we do have a webinar going live right now. Let me make sure that it's actually started, and then we can send you over there. Anne-Marie Band, you guys may know her. She's been a longtime friend of Pre-Market Prep. She's a fantastic trader, and she recently joined Benzinga Pro as one of our, I don't know what we call them. They're experts, the gurus, the mavens. Not quite sure. Anyway, she's recently joined as an expert. She offers her trade ideas now in Benzinga Pro. They're doing a webinar right now. I'm going to send you over there that webinar she's doing on her trading strategies. And then I'll be back at.
Wait, your owner is saying he bought $4 worth of Luna and sold it for $500 yesterday. Holy shit! See, that's what I'm saying. If you would have put $100 into it, that's incredible.
Look, yes, it can work. It just please do this with like.
Yeah, it's like I'm sure someone in Vegas this
couch
weekend.
Couch cushion money only.
I'm sure
couch cushion money only.
I'm sure someone in Vegas this weekend made thousands of dollars, but it sure as hell wasn't me.
All right, everyone, smash the like, please, and thank you. And please remember, all the information from this show is meant to be used as informational purposes, not for investing or trading advice. We'll catch you guys tomorrow morning. I'll catch you guys in an hour and a half at the close, and I'll see you there. Stay green.
Peace and love, y'all.
Where's our outro?
We'll be right back.